Good morning, good afternoon, and good evening, everyone, and welcome to the Winter 2021 IPO Bootcamp. My name is Colin Mahan, and I'm a program manager at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit dedicated to enabling entrepreneurs from all over the world to realize their maximum potentials and grow. As you may have seen in the chat, the Nasdaq Entrepreneurial Center, along with our partner Mentor Cloud, launched a free mentor matching platform for entrepreneurs called Mentor Makers. So you can find or become a mentor today by using the link in the chat. Quick housekeeping item before we get started with everything today. We're going to open up for live Q&A at the end of each session. So please submit your questions in the Q&A function at the bottom of your screen throughout the discussions. Now, none of what we do here at the center could be possible without all of the amazing support and contributions from our sponsors, including Nasdaq, Lehigh University, Bank of the West, KPMG, Wilson Sonsini, Woodruff, Sawyer, and BPM. We're humbled by their contributions. During these still unique times, the center is curious on how sentiment is among the entrepreneurs we work with. So we're going to start by taking a quick poll to let us know how you're feeling about your business right now. The first question, how are you feeling? 2020 and 2021 have been a roller coaster. So are you optimistic? Are you just surviving? The second question, what's keeping you up at night? Helps us understand the responsive programming that we should be providing you, the entrepreneurs we serve. So just take a moment, really appreciate you participating in the poll, and then we'll jump in and get started. And welcome everyone, Toronto, all right. Sunnyvale, California, welcome. All right, I'm gonna end this poll, share those results really quickly. Looks like optimism's on the rise, which is good, but still understand that there's some anxiety and just survival mode out there. Looks like you're all in the right place because finance is something we're going to be talking about a lot today. So I'm going to stop sharing those results. And thank you all for participating in that poll. Lastly, before we get started, let's take a look at the agenda for the day. We're going to kick off our program with a market update and overview, then jump into our first panel, preparing for and staying on track for your IPO. Then immediately following that panel, I'm thrilled to share that we'll be joined by California First Partner, Jennifer Siebel Newsom, in a fireside chat with our Executive Director, Nicola Corzine, to discuss the importance of creating boards that reflect true diversity. Stoked to have them. Then transition into our second panel where our guests will share more on executing your IPO, followed by a 10-minute break. To round us out, our last session will cover achieving success as a new public company. Please note, the same Zoom link will be used for the entire day. So without any further delay, please join me in giving a warm welcome to our first presenters to share the IPO market update. Pierre is the head of Equity Capital Market Americas at Bank of the West BNP Paribas, and Will, director of Bank of the West BNP Paribas. So Will, Pierre, welcome. Happy to have you. Over to you.
Thanks, Colin. Pierre, do you want to say a few words to kick off? Okay, maybe not. So I'll go ahead and get started. So thanks again to Colin and Isis for having us on yet another NASDAQ IPO Bootcamp. Oh, there's Pierre. Pierre, you want to say a couple words?
Sorry about that little technical snafu. So I'm Pierre Lapome. I'm heading the Equity Capital Markets Group for BNP Paribas in New York. I have around 20 years experience in IPO on the equity offering. As will show you, it has been a very busy and interesting year in US IPO market, and I will be present for question after that if you have. Will, up to you.
Thanks, Pierre. And Isis, if we could bring up slide 2, please, that would be great. So again, thanks to Colin, thanks to Isis, thanks to the NASDAQ Entrepreneurial Center for having us on yet again. I think this is now my 4th IPO bootcamp to join in the last 2 years. So to those of you who may have seen me on previous ones, hello again. And for those joining in your first bootcamp, it's great to meet you and present to you virtually. So in the next couple of slides, I'm going to go through a few different things. We'll do a quick review of what the IPO market looked like in 2021. We'll go over kind of what our view is for the broad outlook in 2022. And then we'll touch on some factors that I think are important for potential issuers to consider when thinking about possible IPO windows in 2022. So when I presented last December, Obviously, it was at the end of a pretty wild year. And I think there were some expectations among those who were part of this boot camp last year that maybe, after the COVID influenced year, that the IPO market would sort of come back to a normal, steady state, kind of status quo pre-COVID type market. Well, now looking back at the end of 2021, as it turns out, that expectation really could not have been further from the truth. So there are a lot of superlatives that have been thrown out to describe what this year's IPO market has looked like. Outstanding, prolific, maybe a bit overwhelming, and maybe even some ECM bankers would probably tell you it's been a bit exhausting. But suffice to say that by pretty much every measure that you can think of, this really has been a record-breaking IPO market. So let's start by taking a look at the top chart on this page. Now, what this chart shows is yearly IPO volumes in the US going back to 1990. This is for deals greater than 100 million. And this, by the way, is excluding SPACs, which are obviously a very different part, but important part of the market. But just for the purposes of comparing apples to apples versus previous years, we've left out SPACs from this page. So what you can see, 2021, again, excluding SPACs, has, in terms of both IPO volumes, i.e. the dollar amount that's been issued, as well as the number of deals, we've really blown out of the water all previous years in history of the US market. So, there was a lot of talk in the market, thinking back to the dot-com era, 99, 2000. That was sort of a high point for IPOs, and many people thought that record really couldn't be broken until this year. And so you can see we're nearing 150 billion in IPO volumes. Again, that's ex SPACs across 273 deals greater than 100 million. The second highest year behind this year was 2000 during that dot-com era, where we had around 90 billion across 193 deals. So we've essentially crushed that record this year by around 50%, or more, which is pretty remarkable, to say the least. So when you break that down into kind of what the sector mix has looked like this year, as you might expect, tech has been the biggest sector by far. It's made up about half of IPO issuance this year, a little under half, 72 billion of issuance across 103 tech deals that are greater than 100 million. So again, looking at the tech specific sector, we've also beaten that record in 2000 of number of deals, which was 80, which a lot of people thought couldn't be broken. And we've also broken the volume record, which was set in 2014, when you had this massive Alibaba deal that contributed to a big surge in overall volume. So we've by far surpassed in the tech market the record for volumes and the record for number of deals. So while we're focused on the tech market on this page, I just wanted to point out that this has been a pretty beneficial market, not only to the tech sector, but many, many other sectors, which I haven't highlighted on the slide, have also broken records. So just to give you a sense of that, in healthcare, we've had the most prolific healthcare IPO year of all time. 97 deals above 100 million, raising around 26 billion, which surpassed last year's record, which no one thought we would beat, which was 23 billion. So we've now had 2 years in a row of record healthcare IPO volumes. And then when you go to smaller sectors, but ones that are still an important part of the market, consumer products, for instance, it's been the best year for consumer products IPOs of all time. 14 deals raising 9 billion, above 100 million. And again, it's looking at other sectors like food and beverage, 6 deals in the food and beverage sector raising 3 billion. Again, the strongest year for food and beverage IPOs of all time. So it really has been shared success across many sectors for this year's issuers coming to the IPO market. So if we could move on to the next page, page 3, Isis, that would be great. So we've talked a bit about the broad market trends. I want to touch a little bit on some specific IPO market trends that we've been focusing on this year. And some of these are holdovers from last year that have become, I think, even more prominent trends this year. So there's 3 trends on this page I want to briefly touch on. The first has been the trend of companies highlighting ESG and sustainability angles even more than they were doing previously in their IPO marketing processes. So we've seen a mix this year. There's certainly been companies that are truly in sustainability focused sectors that have started to come into the market. And I think that's going to be a big trend we'll see in the coming years. But you've had companies like Fluence Energy, which is focused on energy storage, and FTC Solar, which is creating software to help optimize electricity generation of solar panels. So these are obviously very clearly in sustainability and energy transition focused sectors. But beyond that, we've seen companies in sort of more ordinary quote unquote sectors also focus more on the sustainable and ESG related aspects of their business. So you have Allbirds, for example, which is a footwear company, but they're focused on sustainable footwear, and they highlight that very clearly and very prominently in their S1. And similarly, companies like Honest Company, which is a personal care and healthcare, household care products company that has also emphasized their ESG and sustainability credentials. So it's not limited to companies that are in, I would say, obviously sustainability focused sectors. So that's been a trend, and I think that's going to continue. Another trend has been in the direct listing side of the market. Now, this is still obviously a very, very small part of if you want to call it the broader listing / IPO market. We've seen 6 deals this year, which, starting from a low base, has been a substantial increase on previous years. It's basically as much as we've seen in all previous years combined. That being said, compare it to the 273 deals that I've mentioned we've seen go through the regular IPO market, and then compare that to the hundreds of SPAC deals that have happened this year. It's obvious that it's still a very small part of the market, but it's one that we want to continue to monitor. I think it will continue to grow. There are some concerns that people have had with regards to sort of mixed results post-IPO, or post-listing rather, just in terms of liquidity and research coverage. When you go through that normal IPO process, you have the bank's research analysts involved from a very early stage, and they often will continue to be involved through picking up coverage post-IPO. And then you have that sort of tailored investor book that the issuer has a hand in putting together, which you don't have in the direct listing, and that can contribute maybe to some liquidity issues. You see the same thing in companies that list through a de-SPAC, by the way, when it comes to less research coverage and sometimes less liquidity than when you go through regular IPO. But anyway, that's been a trend that we'll continue to monitor, and I think it'll continue. Nobody's really tried this concept of a direct listing plus capital raise yet, but that's something that both exchanges have now said is possible and allowed. So maybe we'll start to see that next year. Now, the third trend I wanted to hit on this page is the SPAC market. I haven't focused that much on the SPAC market in this presentation because honestly, it merits its whole own workshop and presentation, and you could spend hours on it, obviously. But suffice to say, obviously, it's been a thing that a lot of people have focused on. We really hit the peak in Q1 with nearly 300 deals and nearly 100 billion of SPAC issuance, which is pretty wild to think about. And when you started to see some negative issues come out in the press, and the SEC put out some statements with regard to issues around disclosure and accounting for the warrants that are included in a SPAC unit IPO. So once you saw that, you sort of saw a drop off in Q2 and Q3. That being said, it has been creeping back in Q4. We're at close to 150 deals now in Q4. I think it's a little bit difficult to predict what the SPAC market's going to look like in the next 5 years. I think it's going to become for sure a regular part of the IPO market, and we're going to see a steady number of years coming each year, a steady number of deals coming each year. I don't think we're going to be sustained at what the issuance volumes have been like in 2021. I don't think that's sustainable, but I also don't think we're going back to the 15 or 20 deals that we saw kind of every year before 2000. So I think somewhere in between that is going to be the steady state that the SPAC market finds. One issue is that as you keep having these IPOs come to market, this pool of capital that's been raised by SPACs and is now in search of a target continues to grow. So I think that's great if you're a private company who's looking to go public through a SPAC. But I think there have been some concerns about whether there are enough truly quality targets out there to merit this large of a pool of capital that's out competing with each other for a target. So that's something that we'll continue to monitor and will continue to be a major part of the IPO market going forward. So that hits the highlights of 2021. If we can move to the next page, and we'll start to talk now about kind of what the outlook looks like for 2022. And I think a lot of people are excited about what the IPO market's going to look like in 2022. If you look in the press and you read through various articles, you can see that there's been a lot of speculation about this IPO pipeline in 2022. Despite the fact that there were so many deals done this year, there's a lot of companies that people feel are IPO ready and are going to be looking to go in 2022 as well. So I think there's certainly high expectations on that market. I want to hit on a few trends that I think are useful to private companies and potential issuers, a few factors rather to think about when maybe thinking about going in 2022. So the first one I wanted to talk about, which some people may not realize, is there's actually historically a lot of seasonality in the IPO market in the US. Typically Q2 is when we see the most issuance. And that's been true in previous years, as well as this year, specifically with the huge IPO surge we saw in tech IPOs in Q2 of this year. And you know, there's various factors that contribute to that. I think in Q2, you generally have more companies that have fully tied up their full year financials and are ready to go. They've had more time to prepare throughout Q1. So you've seen that sort of seasonality in the past. That being said, I wouldn't be surprised if you see more companies kind of lining up to try to get all of their ducks in a row, so to speak, and be prepared to go in Q1. I think since there's this expectation that there's a lot of deals looking to come to market, some folks may feel that there's an advantage to kind of get out there earlier before there's a huge supply of deals coming. So that's something to just think about as the seasonality in the market, and maybe preparing to be ready earlier in the year could be a benefit for certain issuers. Another factor that I wanted to talk about, and obviously is a very important factor in the IPO market, is IPO aftermarket performance. So if you look on the bottom left-hand side of this page here, this is a chart of 1 month aftermarket performance, the average 1 month aftermarket performance for IPOs per quarter going back to 2019. And you can see when you look at Q2, Q3, Q4 of 2020, those were some of the strongest quarters that we've ever seen in terms of alpha generated by IPOs. That's definitely dropped off in 2021. One factor certainly being the huge supply of IPOs, some volatility in the market in the last quarter as well. So we've seen it drop off, but it's been sort of still decent performance by historical standards this year. Q1 through Q3 were all an average return of over 20% in the first month following the IPO. We have seen a little bit of a drop off in Q4. Q4, we've averaged just over 10% return, which is a little lower than we've seen in the past couple of years. That being said, I think the market can handle a few months of diminished IPO aftermarket performance and continue to maintain its strength. I think if you start to see that sustained for several months, maybe it has an impact on the market. Certainly, maybe it causes investors to demand a little bit more of investor-friendly pricing, which some issuers will still go forward with their IPO. Others may, think about delaying until market conditions improve, if that happens. So something to monitor, the fact that it has dropped off a little bit. But that being said, I don't think it's flashing any red signals yet for 2022. So that's kind of my view on overall aftermarket performance. And if you look at sector-specific performance, I did want to highlight that not all sectors are treated equal by investors. Clearly, tech for sure is a sector that investors view as a real alpha generating sector in the IPO market. And I think if you look at some of what we've seen in the past, even during more challenging periods in the IPO market, investors will view tech issuers that have sort of proven that they can generate sustained independent revenue growth, kind of regardless of what's happening, or at least less impacted by what's happening in the IPO market. If you have these kind of high quality tech issuers coming to market, showing that independent growth, they should be able to execute deals even during slightly more challenging markets. And again, we've seen that in the past. So if we move on to page 5, this is just a brief view of kind of what the IPO pipeline looks like going into 2022. Now that in the last couple of years, the ability to file confidentially has moved from only emerging growth companies to now every company that's doing an IPO can make a confidential filing and go through those first couple rounds of SEC review without filing publicly. It's tougher to get sort of the official view of what the pipeline looks like going into 2022. So this is the 180-day filed pipeline. Again, if you read through the press and there's various articles out there, you can see that well beyond this, there's many, many companies that are anticipated to be thinking about an IPO for 2022. So my takeaway would be, as I mentioned on the previous page, there's probably a benefit to being ready to go perhaps a little bit earlier in the year than maybe you would normally, just because, again, of that rush of IPOs that may come later in Q1 and into Q2. So if we move on to page 6, which is the final page of my update, just wanted to talk a little bit more about kind of once we get into 2022 and say you're an issuer looking at, okay, how do I think about timing my IPO specifically? I've gone through the process of filings. I'll be ready to go at Q1 or into Q2. But when I get into those final weeks, how do I think about whether it's the right time to launch? And there's a couple of factors that go into that. Again, one that I mentioned on page 4, which will continue to be an important factor, is IPO aftermarket performance. So on page 4, what I showed was kind of that 1 month aftermarket performance. And what I have on the bottom left-hand side of this slide is sort of a different way to look at that. This is looking at an IPO index as compared to performance of broader equity market indices like the S&P and the Nasdaq. And as you could see back on page 4, and as I mentioned, that performance in the last couple of months has dropped off a bit. Again, I don't think it's necessarily an issue unless that's sustained for a few more months, but it's something to monitor. Another factor, which we've talked about in previous presentations, if you've been to some of these previous IPO boot camps, has been equity market volatility. And we used to say, in the ECM world, that if the VIX was above 20, it was very hard to execute an IPO in that environment, and it might be a smart idea to wait. The last couple of years have sort of proven that maxim a little bit, not incorrect, but maybe outdated, because we've seen plenty of deals get done in the last couple of years when the VIX was above 20. But it's still something to monitor. And I think if you see a real spike in the VIX, it can certainly lead some people to think about pushing back their IPOs until volatility is a little bit more muted. So that's one other factor to watch. And the last factor that I just wanted to mention is equity fund flows. Now, that's something to continue to monitor. And what we have on the bottom right-hand side of this page is a view of both mutual fund and ETF equity fund flows over the last couple of years since 2019. So it's pretty interesting to see that after a couple of years of net outflows from equity funds from 2019 through 2020, we've started to see pretty steady inflows, net inflows in 2021. And that's a good sign for the IPO market, because if you're having inflows into these funds, it means that PMs do have more capital that they have to deploy. And the IPO market is one way to do that. So definitely a positive for the market that we're seeing these inflows. That's something that we'll certainly continue to monitor closely. I think there's certainly some speculation in the market that if we're entering a rising interest rate environment, then it may be good for equity fund inflows, as some folks may try to rotate away from fixed income during a rising rate period. So definitely something to monitor as we get into 2022 as a factor that will continue to contribute to the strength of the IPO market. So that concludes my prepared remarks. We're at 12:25. I think we have a couple minutes for Q&A. But again, thanks to everyone for joining, and thanks to the center for allowing me to do yet another market update.
Awesome. Thank you so much, Will. We do have a couple questions. One from Doug. Thanks for the question, Doug. Does the IPO index treat SPACs and traditional IPOs equally, or does it exclude SPACs?
That is a good question. I actually don't know off the top of my head. I'd have to double check, but that's a great question. I don't know if Pierre, you know the answer.
I think it excludes SPAC. I mean, it's the Renaissance IPO index. I think it's for traditional IPO. Doesn't trade. I mean, SPAC, until they find their acquisition, will trade around $10, which is their issue price. So it will give you it will distort the numbers. So I'm pretty sure it's without SPAC.
Thank you, Pierre. I didn't know either. What should we know about the level of redemptions we are seeing in SPACs, and its fading appeal for entrepreneurs to go public?
That's a very interesting question. Each de-SPAC, I mean, we are talking about the redemption at the time of the business combination. Each de-SPAC has its own characteristic terms on everything, but that's certainly something as a concern, because when you enter the discussion, you maybe don't have all the visibility about how much cash in hands the SPAC will have at the time of the merger. And between the announcement and the completion of the merger, you have few months on it can be a challenge. If you're combining with a SPAC which has $200 million in cash in hands at the beginning of the process, but experience redemption rates of 75-90% we've seen even in situation, it's not the same picture. So you have some adjustment with sometimes, you have a complement of equity coming through a pipe investment, but that's clearly something to watch on a potential concern when you're looking at an acquisition by a SPAC. Yes.
And as Will mentioned, the topic of SPACs could take an entire hour, and we are planning on doing one in 22. So for those of you looking to learn more about all of the things SPAC related, we're going to be hosting one of those. You have today more than 500 SPACs which are outstanding and have not announced an acquisition yet. So as you know, they have a pretty short period of time to find their targets. So you can expect these guys to be super active. Awesome. Thank you, Pierre. All right. Well, we have time for maybe one more question. And I think this one is broad enough to round us out on just like an overall takeaway. Will, and Pierre, feel free to chime in on this too. What's driving all these IPOs? And I think you covered it, but at a high level.
Yeah, look, I think from the issuer side, the last couple of weeks maybe being excluded, where we've seen for the last couple of years, after the recovery from COVID, the equity markets have continued to kind of push new highs. Tech valuations are at highs. You have issuers able to go in and depending on the growth level, if you're a tech company, getting valuations in excess of 20 times revenue, sometimes a lot more. So I think the ability to come in, raise capital, list at an attractive valuation is pretty appealing to issuers. And then on the investor side, they've been able to absorb that volume as long as the alpha generation has been good. So I think it's a mix. It's sort of a virtuous cycle of continued strong returns, continued growth in the equity markets, leading to high attractive valuations for issuers looking to enter those markets.
Great answer. And thank you so much, Will and Pierre, for joining us for that market update. Great to have you back. All right, folks.
Thank you.
Thank you.
We'll see you next time. Up next, our expert panelists will cover preparing for and staying on track for your IPO. So please join me in welcoming Victor, who's an associate at Wilson Sonsini. He is going to be our moderator for the discussion. We've got Janine, who's a partner at KPMG. We've got Michael, who's a partner and SVP of D&O at Woodruff Sawyer. And we've got Jesse, CFO at Revolve Group. Welcome, team. Over to you, Victor.
All right, thanks, Colin, and thanks to the center for having us. I'm Victor Nilsson. I'm a senior associate at Wilson Sonsini. We are a leading law firm in the IPO market. Frequently advise high growth companies, particularly in the tech and life sciences space, on their IPOs and other capital raising activities and transactions. Janine, would you like to go next and introduce yourself?
Sure. Can you hear me okay?
Yes.
Great. Okay. Hi, everyone. Happy to be with you today. My name is Janine Daly. I'm an audit partner at KPMG based in the Pacific Northwest. I work with companies really of all sizes, both public and private, primarily in the consumer market and technology space. It's been an exciting year for the companies I work with. I've worked with one who was a SPAC acquisition target, and another that successfully completed their initial public offering in September. So looking forward to chatting with this group.
Okay, Michael.
Good morning, everyone, and thank you for having me. I'm Mike Ferraro, and I'm one of the partners at Woodruff Sawyer. Woodruff Sawyer is a brokerage firm that works on all lines of insurance. My area of expertise is directors and officers liability. One of the areas we're known for, and I get involved a lot, is this transition from private to public, whether it's through the traditional IPO route, de-SPACs, and a pleasure to be on today.
Okay, and Jesse.
Hey, Victor, and good morning, everybody. Jesse Timmermans, I'm the CFO at Revolve Group. We are the fashion destination for the next generation consumer. So what does that mean? We sell a lot of clothes to millennials. We operate Revolve, which is the core of the business. That's a premium apparel multi-brand retailer for that millennial, primarily female. We have a little bit of men's clothing, but mostly female. And then we also operate Forward, which is our luxury destination, which carries the very high-end brands, Balenciaga, Saint Laurent, and the like. So great to be here. Thank you.
Okay, great. Thanks, everyone. So the topic of the panel is, preparing for and staying on track for your IPO. So maybe to kick things off, I thought we could talk about how far in advance of an org meeting you should really start thinking about preparing for your IPO. What are some specific things that require a lot of lead time? And just so everybody's on the same page, org meeting is sort of the official kickoff of the IPO process, right? Where you have the investment bankers on board, the outside auditors and all of that. But of course, there's a lot of preparations that go on before then. So maybe Jesse, if you want to start and speak from your experience and some learnings from that, that'd be great.
Yeah, for sure. I think, with anything, the sooner the better. I think ideally it's in that 18-month zone. We probably started in that probably 12 to 18 months ahead of time, at least preparing. And we started with just the baseline. Can we execute a consistent 5-day close? So starting from the beginning, can we close the books accurately, consistently, and on time? That was number one. And then building some muscle in the financial reporting area, and financial reporting being broadly, new to a company that's going through this would be all the SEC reporting, all the SEC disclosures, but more broadly writing the technical accounting memos, getting your controls in place, especially those disclosure controls and procedures, and starting that early, and again building that muscle so that when you get to that crunch time of IPO, you can really focus on that process and not worry about the base level that you need to have in place. I think along with that comes starting to build the team. In a private company, you probably wouldn't have necessarily a director of financial reporting, for example, or somebody focused on controls and disclosures and all the public company stuff that goes along with that. So that's a close. And then also the forecast being really important. Do you have a predictable business? Can you consistently forecast? Can you identify the KPIs? What are those KPIs that are going to be going into the SEC documents? Of course, as a company, there's hundreds of KPIs you measure. You're not going to include all of those in your public filing. So it's picking which ones you're going to include and doing that ahead of time, because you realize a quarter later, 2 quarters later, 3 quarters later, maybe that's not the right KPI for the long term that you want to consistently disclose. So figuring all of that stuff out before you actually have to do it. And then that leads into, going through some mock earnings releases and mock just quarterly process from close to filing to the earnings release to the script. The scripting is another thing that you just don't have to do necessarily as a private company, that takes a lot of time. So I think it's all of those, getting ahead, building the muscle, building the team, so you can focus on the process and have a sustainable process post IPO. The IPO is a process at this moment in time, but you have to live with that for the rest of your life.
Yeah, those are all great points, and certainly consistent with how we advise our clients too, and just putting a lot of rigor around your main risk factors, thinking about what they are, and as far in advance so you can build some rigor around that. But you spoke a lot about internal controls, financial reporting. So Janine, maybe I could pass it to you to comment on this too, just how far in advance and some specific things perhaps within preparing your financials for an IPO.
Sure. Yeah. And when I think about financial reporting, I really think about it in 2 buckets. On the first side, you have the external financial reporting requirements. So, any financial statement set that goes into an initial public offering needs to be audited. So if a company currently isn't being audited and is thinking about an IPO in a couple of years, that's the best place to start. if a company has historically been audited and they're sort of getting closer to that IPO date, there's likely an upscale that needs to be done to the audit to get it in accordance with PCAOB standards. That's the requirement. And that's really, it's not a light lift. There's quite a bit of incremental work that needs to be done to bridge an AICPA audit, which is really what most private companies get, to a PCAOB audit. And that switch, that can be done at any point in time. So again, depending on where you're at in your journey, that would be something to think about. There's also the requirement for quarterly financial information. In a, in an S1, there's maybe somewhere around 8 trailing quarters. So the quarters that go into that document usually are reviewed by an external audit firm. So that's also something that a company can get ahead of as they're thinking about their timeline. And then, Jesse touched upon accounting policies. There are certain accounting policies that companies elect when they're a private company that they can't elect when they're a public company. So thinking about unwinding some of those as you're preparing for your S1, that's something to think about as well. And then, the second piece of that, the other side is the internal financial reporting process. Jesse said the close process, right? That, companies could be going from a 30 to 45 day close process down to a 5 to 10 day close process, right? And that's not an easy task. So companies may want to think about doing a potential IPO readiness assessment that could have some folks come in and say, hey, here's some gaps and things to be thinking about to really get your close process a little bit more timely. And then because as a public company, you'll be reporting quarterly, there's probably some incremental policies, procedures, things that a company needs to do around that quarterly reporting process to get the right cutoff, right? So thinking about that, that's something that you could be doing now to say, how do we make sure we can externally report quarterly financial information? And then lastly, Victor, you mentioned internal controls. I get that a lot, right? What should I be doing now as a private company to think about internal controls? Outside of sort of just creating a more robust internal control environment, I like to advise companies to really think about their systems, right? The systems are obviously most pervasive, and they can take the most time, honestly, to get the right internal controls designed and implemented. So a good starting point is just coming up with an inventory of all the systems and interfaces, and now cloud service providers are really popular. So making sure that those cloud service providers have SOC 1 reports that you can review, getting that inventory together, and then thinking about how do we go about implementing controls over those systems. That's a good place to start for companies.
So clearly a lot of things that you wouldn't have in place as a private company until you're sort of need to have it as a public company. Mm-hmm. So those are all great points. Maybe one technical thing I'll highlight for the group here is, when you go public, it's not as if you need to have all the financials that you will have at the time you finish the IPO at the beginning of the IPO. So usually when you file, right, there's a rule that says you need to have at least one year audited financials upon filing, and then at least 2 years when you file. And I'm speaking specifically about emerging growth companies, but you don't need to have that second year in place when you do your initial submission. And that's very helpful to sort of start the clock with the SEC, get the review going. One other really big component about related to preparing for an IPO is obviously the governance piece. And Mike, I want to pick your brain on this one a bit too. So it's thinking about, who are the directors on your board? There's independence requirements under stock exchange rules, SEC rules. So Mike, maybe I'll kick this one to you. When do you think companies should start talking or thinking about recruiting independent directors, and particularly for the audit committee chair? There's a lot of companies going public right now. It's quite hard to recruit, is my understanding. So curious to get your thoughts on that, and then also related, how that relates to D&O insurance. If you could speak a bit more about your experience there, that'd be very helpful, I think.
Sure, Victor. Thank you for the question, and you hinted on it. there is a shift from being a private company to a public company. Things that I think investors in the marketplace are going to expect. Certainly, things that D&O underwriters are going to expect through the underwriting process and having an insurance policy that protects your public company. And Jesse touched on this in terms of some of the financial controls. I think it holds true for recruiting adequate board members. 12 to 18 months seems like a really good time frame to be thinking about that recruiting. It always takes longer than you think. And you need to provide ample time for these new board members to entrench themselves in the company and really get to know the company before you head really full steam down that IPO path. Especially true for audit committee chairs. That's a very high demand position. And it's also especially true if you're looking for diverse candidates. So those are, and there's a lot of competition right now, if you will, you hit on that as well. If we think about the D&O process, the second part of your question, Victor, it's also a 12 to 18 month process is ideal for optimal pre-work. It really does start with making sure you have the right team, the right broker, the right advisors. The naive view is that all of the insurance is the same, but if you think about directors and officers liability, it's a very different product. And if those that believe they're just buying a product, they really miss the boat. A good broker isn't selling a product, they're providing counseling services in a high stakes environment. So it's the same reason that you pay top firms like KPMG and Wilson Sonsini. You want brokers to have the level of experience, because D&O insurance to the board isn't a low stakes game. They're very focused on this. So if we think about the two, private and then once you're getting ready to go public, while private in renewing your D&O insurance, I would say make sure you're making a conscious decision of what your program looks like, the renewal before the IPO cycle. So we're talking about, as a private company, the costs are much lower, deductibles are much lower, but you have the right amount in place, because this is a time when boards, especially newly recruited boards, will start asking questions about when, how much do you have and how do you know it's enough. And when asked that, we'd like to put our clients in a position to demonstrate a well-prepared and thoughtful response. And then once you do start going down the public process, so we're talking 4 to 5 months before the IPO, remember, like everything else, time is your friend. And running a proper process takes plenty of time. Their starter gun, if you will, is about 1 to 2 weeks before you file your confidential filing. So we're talking about the first filing with the SEC. As a process, D&O underwriters will want to see the confidential S1. So you want to make sure that you have NDAs in place with the carriers in order to be in a position to provide them the submission, which is your S1 filing.
Yeah, all great points. I think related to governance too, one thing I would just highlight for the group is, so of course, many companies who are VC backed or sponsor backed will have directors on the board who are affiliates of the sponsor or the VCs. And some VCs will have policies where those directors can't serve on the board of public companies, so you have to start planning sort of far in advance where they may need to roll off and you need to replace them. And then, of course, again, the director independence requirements under stock exchange rules, and particularly for the audit committee, there's some heightened independence requirements. Just again, planning ahead is key. The other overarching point I would say about how far in advance is, the sort of more you're able to plan in advance of the org meeting, at least in my experience, lets you go much faster post org meeting. But if you sort of call us and say, well, we have an org meeting in 2 weeks, that could sort of delay, or not delay, but make the process post org meeting longer, because you may not realize how much actually needs to happen before you're public. So maybe moving on, so a company has sort of made the decision, yes, we want to evaluate the possibility of going public. We want to start bringing on bankers and other advisors. What are some key factors there? And Jesse, I think this would be really helpful from the company perspective to hear, some key things. What do you think about when you choose your bankers and other outside advisors?
Yeah, and maybe I'll tie it into your comment that you just made as well, and tie it back to that kind of planning and pre-planning ahead of the org meeting. I think as many service providers as you can line up ahead of time, the better. So as a private company, for example, you might not have counsel that is public company counsel, or an auditor that is really ready for public company requirements, and Woodruff Sawyer on the D&O side. Maybe you have a different broker that's not as keen on the public company D&O. So I think, in line with that 12 to 18 months, starting to line up your team, team internal and then team external as well, with everybody on this call. So I think as much of that as you can do in advance, and then everybody's familiar, you minimize change during that really challenging IPO process. And then when you get to bankers, and this goes, I think, for everyone on the team and the external team, is culture and fit. You have to absolutely make sure you've got the baseline. They have to understand the business, understand the sector, understand your story, not necessarily, the sector in general, but your specific story. And do they believe in it? Do they understand the thesis? Can they communicate to the street? Can they help you through this process? And there's a lot of storytelling in the S1 and trying to communicate to the street what you're trying to do. So having that understanding, I think, is critical, and having some passion for the business, and not just treating it as a transaction. And then that goes into kind of culture fit, personality. Everybody's working really hard, through the night for multiple months on end. So I think you have to have fun. You have to get along with people. It has to be productive. You don't have time for any conflict, really. So, I think just making sure that everybody is, for lack of better words, just getting along, and getting the work done. And, I think on the banker side as well, in that 12 to 18 month advance period, having informal touch points, going to lunch, going to dinner, going to drinks, whatever it is, just to get to know those people and who you're going to be working with. And with that, not just focusing on the MDs, but the associates and the VPs at the level that are actually going to be in the trenches with you, grinding on those documents, running models. So I think focus on the whole team, and not just the bank, but the individuals that are comprising that team.
Yeah, no, that's interesting. And just a quick comment from the legal side is, folks may not know this, but during an IPO, as you're selecting your counsel, you also, as the company, maybe one of the few times you have significant input, if not complete input, on who underwriters will hire as their counsel. And that can make a huge difference in the process and how well things are run. And especially if company counsel and underwriters counsel have worked together many times before, it can make the process quite a bit smoother than other times. But maybe, Janine, I'd be curious on your thoughts on this topic too, and maybe other types of advisors. I know sometimes companies will bring in specialized accounting firms, but also just generally on this, what you've seen work well and maybe less well.
Yeah, I think the most important thing is, at the beginning of this process, once you have your service providers all lined up, is you really need to get everyone in a room, on a call, right? Nowadays it's on a call, and just align on requirements. It sounds simple, but there's a lot to think about. And what I mean by that are, what financial statements are required, what periods. Victor, you mentioned, sometimes 1 year is okay for the first confidential filing. Sometimes it's not, depending on the time period when you are doing that first filing. What is required for pro forma financial statements? Have there been any acquisitions that require financial information? What quarters will be included? I think companies don't always think about from a management perspective, that's actually a point of negotiation with the underwriters. There's some requirements around stale dated information, but your trailing quarters, that is a conversation that can be had to align on what everyone wants in the document. So getting everyone on the same page around that is really important, because that really then drives the entire process, right? what each respective party is focused on and divvying up responsibilities to make sure that you have enough manpower, because you said, Victor, you may need to bring on a consultant to help with some technical accounting things. You may need to, as management, hire maybe a couple people to build out your team, depending on everything that is required. So that's important. And then the other thing that's also really important is just establishing who's going to have their pen in hand for the different parts of the document. Again, sounds simple, right? But there's so many different parties involved, and there's different pieces of the document that folks can handle. So someone may be focused on the box, the marketing materials right at the beginning of the document. Someone else may be focused on MD&A. Other folks are focused on the disclosure requirements, pro formas. Divvying that out and making sure you're not overlapping is important from an efficiency perspective. And then the last thing I'd say is just having regular touch points, especially in this remote environment, is super important. So the last IPO I did, it was entirely remote, from org meeting to declaration of effectiveness with the SEC. And it was so important that we were getting all hands together weekly, even if it was just 15 minutes, to just get a brief update and answer questions so people can kind of proceed without roadblocks, because you frankly don't have time, right? So the other thing too is it's helpful for management to sort of create a direct line of communication between the auditors and underwriters council. Jesse can probably say that management has a million things going on and a lot of competition for their time, right? Especially when you get into the roadshow part of it. So there's things that those two parties can agree upon and discuss without, bogging down management in their process. So I think having that direct line of communication is helpful.
Yeah, absolutely. And in this remote environment, and given very high IPO volumes, definitely echo everything you've said. It's crucial to make sure you carve out some of that time to get everybody on the same page, and quite a bit can happen, among counsel and other parties without bogging down management. So all of that, I would echo all of that. Mike, I mean, maybe if you want to comment on this too, if I'm not sure if the working group composition so much impacts this, but maybe more generally, going back to some of the things you talked about, insurance. Maybe I'll just pause there and let you speak for a minute on this.
Sure. I do want to come back to part of the question in terms of what are important factors. I think this is true for most service providers and advisors you're looking at, but chemistry is kind of the theme that I was hearing between Jesse and Janine, in terms of also having a team that you like, that knows you, that you work well with. It'll make things go so much smoother. When I think about the selection of an advisor on the insurance side, is the firm and the experience of the team. It's a very fragmented industry we're in, but you don't want the broker that you're hiring to be their deal to be a journey of discovery on your behalf. Data analytics is a really important topic, especially when boards always want to know and always ask the question, how much should I buy and why? The right broker can help you navigate the management team, anticipate these questions, and help boards be comfortable without overbuying insurance. And I'll explain why that's so important in this environment in a moment. Clearly defined process is also really important. Timeline, budgets, underwriter communication, all that, and then having your broker be alongside you and even presenting to the board of directors. Doing those things and taking those steps in a well thoughtful manner will lead to no surprises. We don't want the insurance to be the surprise of all the work that everybody's doing. And then just what other resources and training is provided. Transitioning though to kind of D&O specific environment, I'd like to focus on two things. Everybody always wants to talk about what is its cost, and we're in an environment where costs are very high from a historical perspective. But to provide a proper framework, I think the litigation environment is also helpful. And just as a frame of reference, starting in 2017, so Woodruff Sawyer tracks frequency of litigation on an annual basis. We look at individual industries as well. And the first time that we've been tracking this information in 2017, more than 4% of the companies publicly traded were sued. And I'm talking about the major Nasdaq and in the New York Stock Exchanges. So roughly 5,000 or so publicly traded companies. We hadn't seen that before. And as bad as that was, it peaked in 2019, where 5% of the public companies were sued. Now, contrast that by litigation trends for IPOs. It's even worse, unfortunately. For example, 28% of the companies that went public in 2018 have already been sued, which is an average annual frequency of 9%. Then you had, and there's been some mention of this, you had de-SPAC transactions that happened. And now the underwriters, the D&O underwriters, right or wrong, have a new sector to be even more concerned about. It might be unfair, but the perception is that these de-SPAC transactions are even riskier than IPOs. Thus, IPOs have starting to become more sought after. So what does that all mean when we talk about pricing? Since 2017, where we saw the litigation really tick up, the cost of the first $10 million of insurance, and keep in mind those companies buy more than 10 million, is up over 5x. And the retentions, the deductibles, are up nearly 8 times. So what does that mean today? We track pricing on a per quarter basis. And in Q3, the average cost of the first 10 million of limit was $2.1 million. Yes, $2.1 million. And the average deductible was 11 million. But keep in mind, pricing is differentiated. Good companies get preferential pricing. Make sure to have a clearly defined process with your broker that puts you and the company in the best position to mitigate these high costs. And maybe leaving on one positive note, it looks as if the pricing and retentions have peaked for IPOs and for D&O insurance for companies that are going through that. We have had in the last 6 months to 12 months a healthy addition of new insurance carriers enter the marketplace. And so with the supply side of insurance going up, that is certainly helping, despite the fact that IPO litigation has stayed really level in 21 versus 20. Overall litigation is looking like it's going to drop about 20% compared to last year as we finish this year. So maybe some bright news about cost trends and litigation trends in the future.
Yeah, that's all. That's all very interesting. I mean, maybe a couple other points to highlight from a litigation risk mitigation perspective. So obviously, directors and officers also have indemnification agreements that are entered into either pre-IPO or in connection with the IPO. There's generally in the bylaws sort of exclusive forum provisions where certain cases have to be litigated. For example, in Delaware, when it comes to fiduciary duties or even securities claims in particular federal courts. So that may be helpful too. And then just for the benefit of the group, of course, while so much of the IPO is telling the story and making sure that we have a successful IPO, in the background, obviously Counsel is working very hard on the diligence exercise and making sure to really minimize risk as much as possible. And the risk often comes from alleged material misstatements and omissions in your disclosure documents that are provided to investors. So certainly you need to have well-experienced counsel to help you with that would be my recommendation.
And I know there's some interest in de-SPACs here. That's actually one of the, I'll shift for a moment. That is one of the concerns about de-SPACs from a litigation perspective, because most, if not all, but most are putting annual projections. I guess if you're a biotech company, you're not necessarily. And that is a point where the plaintiff's attorneys can look after the fact and say, well, this is what you said in your file document and the investors relied on this, but this is not what happened. And we're seeing in 2021 a lot of litigation in that front specifically to those disclosures.
Yeah, that's consistent with what I've heard as well. Jesse, maybe back to you, and you've actually sort of touched on this already, but wanted to give you a chance if there's maybe any other points. So we talked a lot about external advisors. You did hit a couple times on internal sort of key hires, but any, I guess, particular positions you would highlight, like these are crucial, you need to have these in place, ideally folks with public company experience, and maybe when in the process it would be ideal to bring them on. Obviously the CFO, but maybe some others.
Yeah. No, I'd go back to that same kind of cadence. Number one, make sure your close process is solid. And you may have a solid team that can execute, like Janine said, a 30-day close, and that's okay as a private company, but you have the team that can execute a short, consistent, accurate close. Also public company, having some public company experience, even on that core GL team, and just understanding disclosures and how it works through the whole system. So I'd say start there with the, solid controller, VP of accounting, whatever title that is, assistant controller, and your kind of senior accountants, and making sure that team is rock solid. The next one, and this one I think can come in that same, 12 to 18 month, but it can come after that base level GL team, is the financial reporting. So whether that's a director, manager, VP, whatever title you want to give it, but somebody that is solely focused on technical accounting, disclosures, memos, SOX, equity. Equity is a big one we haven't talked about yet, but do you have the appropriate equity systems, processes, controls, procedures in place? Is that flowing accurately through all the way to the financial statements? Can you forecast that? So that would be the next one, is that director, X title of financial reporting. The other key hire, that can come external or internal, is the investor relations. We started with external and flipped over to an internal person shortly after IPO. So we didn't advance hire on that one, which I think was okay. Ideally, maybe in hindsight, we could get that person in earlier. It was about a quarter after we went public, but that has been really critical in the process, not just from the core responsibilities of communicating to the street, managing analysts, et cetera, but just another person internally with public company experience helping. One thing I severely underestimated was the level of effort regarding education to the employee base on what it means to be a public company, what's going to change. And if you're the only person with public company experience, it's a heavy load. So having multiple touch points with public company experience to help you educate the employees, give them another resource to go to understand what it means to be public. So those are the few key hires I'd call out.
Yeah, that's very interesting. I mean, I think that part of the IR role too is compliance, and particularly once you've gone public, there's sort of Reg FD, right? So requirements around what you can say. You can't sort of selectively give certain people material, non-public information and whatnot. And IR with public company experience can be very helpful in making sure you stay on track there. I think the other role, it's helpful, can be quite helpful to have someone on your legal team with public company experience, not required, and certainly if you have experience outside counsel, will be very involved in the process, but it can sometimes be helpful. And then Jesse, you brought up an interesting point too on equity and cap table management. That's also another big thing in preparing for an IPO, and it can, depending on how well you've managed or not managed your cap table, that can be a significant, can require some lead time to clean that up, and it certainly needs to be cleaned up before you go public.
Yeah, Victor, Jesse said something interesting too on equity administration. I think, people sort of underestimate, right? Once you go public, you likely have maybe different types of equity instruments, options, RSUs, things like that. And people to manage your equity, they're hard to come by. I know a lot of companies have that I've worked with have struggled filling that particular role. So, as you're thinking about sort of your incentive compensation plans, which we haven't touched upon either, but it's an important piece of preparing for all of this, if a big piece of that is going to be equity, that's something to get ahead of, because in this environment, just like board seats, there's a lot of competition for that.
Completely agree. And then, I mean, obviously there's accounting impact too, depending on what your equity, not just equity incentive awards, but other equity. If you have redeemed preferred equity, and it's, you know, all sorts of accounting things. And SEC, you know, when you submit your registration statement, right, the review is from their legal staff, but it's also from the accounting staff. And many times your most complicated comments during the SEC review process will actually be from the accounting team. And so not all on equity, obviously on your financial statements primarily, but can touch equity as well. So
yeah, and they are definitely very interested if you are granting a lot of equity in, let's just call it the 6 months to a year before you submit your confidential filing. So I think that's a good highlight and something to get ahead of with your accountants, your auditors.
Excellent point. Yes. Okay. Well, we spoke a little bit about corporate governance already in terms of the board, but wanted to talk about briefly, you know, some other key corporate governance features. So of course, I think everyone's heard of dual class, and now there's multi-class and different disparate voting rights between classes. And then also various defensive measures that can be or are implemented in connection with the IPO, sort of anti-takeover measures. Mike, maybe to kick it back to you to get your thoughts on some of this, and also how that plays into the D&O insurance process and the risk profile of a company.
And underwriters can be a very negative bunch. They're the ones analyzing risk, taking their corporate balance sheet risk, and providing certain limits at a premium. So making them comfortable on this is certainly very important. We've seen some really good headway with respect to certain court cases that have made certain topics very popular. And so I would say this is really important to embed in the process. Be ready to talk about it when you speak with underwriters and tell them your story. But just to tick off a few key ones, and Victor, you may even allude to some of these. Federal form provisions and state form provisions are really important. This allows you, the company, if you're sued, to control the venue in which you are sued. And there are certainly huge advantages from what we've seen between federal court versus state court for allegations of violation of the Securities Act of 1933 under Section 11. So those are really pertinent points that underwriters, those are becoming table stakes. They're expecting, especially in the federal form provisions, that they have that adopted to the bylaws. Board recruiting, and this specifically, we talked about it earlier, public company experience. The carriers are really interested in not only who the management team is and their relevant experiences in the industry, operational experience, and length of time with the company. Also, if they have public company experience, do they know what that transition's like from private to public? But they really look strongly at the board as well. Does that board have strong public company experience? And we're seeing more questions with some of the laws that have changed in California, where underwriters are focusing more and more on board diversity. So those are areas of focus and things you should be thinking about ahead of time. Dual class shares, from a D&O underwriter perspective, they prefer not to see that. They have tracked litigation, and trends seem to be higher when a small certain few have much stronger voting rights. And then, Victor, you did touch on this as well, indemnification agreements. Your opportunity to have broad language there, it's a great opportunity to take advantage of that before the IPO. There is part of the D&O insurance policy, we call it Side A, that if you have really strong indemnification agreements, it protects the carriers a little more. So being able to proactively talk about that, what indemnification agreements have been modified to really provide strong protection for the individuals, can be a mitigating factor to D&O underwriters as well.
Right, right. And on the sort of dual class point, I mean, certainly we see that all the time in founder-led companies where the founder wants to retain control. I think it goes back to the point you said earlier, right, which is key to have advisors who can give you perspective, right? So you may see increased litigation, but then again, if you don't have dual class, you will quickly sort of lose control over your company. You will not have the same ability to control the company post IPO, and so all part of the preparations to start thinking about that. I want to make sure that we leave enough time for questions, so maybe we can go one by one and just it's just some key takeaways, 2-3 key takeaways from each of you, and then we can move to some Q&A. So Jesse, would you like to kick off?
Yeah, sure. I would say number one, team. Team is the most important. Internal team, external team, personalities, culture, fit, etc. We talked about that. Number two, front load. Like as much as you can get done ahead of time, the better. If you're twiddling your thumbs right before pricing, that would be a great scenario, and you can really enjoy the process. That's not going to happen, but again, front load as much as possible. And then I would say have fun. It's grueling, but it is a really rewarding and fun process if you make it that way. A lot of great people involved. You learn a lot about yourself, the company. So I'd say just enjoy it.
Okay, Janine?
Yeah, I think, I've said it before, but really it's never too early to start planning where, if you have any aspirations, there's things that you can be doing at any point in your journey to get you ready and better prepared for when you actually do formally kick off the process, right? The formal org piece of it, there's so many steps that happen before that. And I think there's a lot of consultants, service providers, folks that love just having these types of conversations, right? It's not like you have to go through the formal process of engaging someone. You can just sit down and pick someone's brain on, hey, what should I be thinking about right now? Is it too early to be doing that? Or is there something, what should I be spending my energy on? So leverage those folks to help you kind of come up with that early plan.
Great. And Mike?
I'm going to steal some of Janine's thoughts there, because one word keeps coming to mind for me, and that's process. When you think about it, whether it's recruiting the right board members, having the right governance strategy, or protecting personal limited liability with directors and officers insurance, much of achieving the best outcome is tied to running a clearly defined process with the right advisors.
Great, super helpful. All of those make sense. So I think with that, we can move into some Q&A, and you can use the Q&A function on the bottom of your screen. We're not going to, unfortunately, have time to get to every question, but please go ahead. One question is, what must an early stage company be aware of if their exit goal is to IPO? And maybe I'll give one piece of this and then let the group weigh in. I mean, one thing to keep in mind is as you're doing private financing rounds, and then potentially an IPO later is, think about the voting rights, think about the various rights, preferential rights you're giving to your investors, which can have an impact on your IPO and particularly as you're preparing it, and then post IPO control of the company. But maybe if others would like to weigh in, Jesse, I don't know if you have thoughts on this one.
Yeah, I think, early stage, it would be that foundation, building the foundation. Janine mentioned, I think, systems. So making sure you've got the right systems in place at a base level. And that's something that will benefit you if you never go public. So focusing on those things that will benefit you in both scenarios, I think is healthy. From an audit perspective too, I think getting the firm in place as early as possible, suck it up and do the PCAOB audit so you don't have to worry about that and that shift later. We ended up doing that multi-year in advance of the IPO, which was very helpful. So I think systems, as much as you can build a team, you don't need to have those last few key hires that we mentioned earlier, but getting a good base level team in place, I think, again, will benefit you private public regardless.
I'll jump in with a comment adding to Jesse's, which is building the right team, and that is both an internal. So if we're thinking the finance function itself, and you can't spend a ton of money, I know that early in those early days, but also having some of the right board members. And they may not be the board members that take you public, some might be, but they may be the ones that help you scale and be really thoughtful about how to build the business from an operational perspective.
Great. You know, and this is somewhat related to this last question, but so and going back to the intro remarks too, but so obviously in the IPO market, you know, we see startups are running for the IPO exit, and you know, so how crucial is it to sort of slow down and make sure you get things right? And maybe Janine, this could feed into some of what you see too. Maybe we'll start with you on that one.
Yeah, I mean, it's tough, right? Because if there's one thing I know about sort of timelines and as you're preparing for the process, right? Like timelines change. I've never worked with a company where they're like, hey, we want to be really thoughtful and do X, Y, Z at these points. And that's exactly what happens. So it's a compromise. I think there is certainly, and I saw a question on, you know, what should we be expecting from an SEC review perspective? And so when I think about sort of taking your time and doing it right, I think a lot about that interaction with the SEC and anything you do, you know, Jesse hit on it on some of the things to do to prepare, but anything you do in that period before you get to your first confidential filing will only make that review process go more smoothly, more efficiently, and help you stay on your timing from a pricing perspective. So I think, you know, when I think about slowness separate from just hitting the right market timing, I think about that, getting the information in the document the right way so that you're not dealing with rounds and rounds of SEC comments, multiple filings, and things like that, which just they're a huge burden on everyone, right? You know, internal and external. And maybe just while I'm talking about this, you know, some things that the SEC are commenting on and are focused on range from, we talked about equity, they're still very focused on non-GAAP, like the prominence of those non-GAAP metrics, pages and pages of non-GAAP metrics. I was listening to a panel from the SEC on Monday for a different event, and they spent quite a bit of time of talking about that, said they saw some companies that were submitting just an entire non-GAAP income statement, which, you know, is not appropriate, and they're going to comment on that. So equity, non-GAAP, they're commenting a bit on just adequacy of some disclosures around subsequent events. And, you know, they really have free reign. There's not, you know, it's not like they're going to limit themselves. So you can really expect anything. And so whatever you do on the front end to limit that review process on the back end is going to be super helpful.
Yes, and I think sometimes when companies are very rushed and don't have all the processes in place, obviously we can have material weaknesses, significant deficiencies, right? And particular material weaknesses that you have to disclose in the document that goes to investors. You know, I'm not sure one is going to have a marketing impact, right? But it's something you do have to disclose. And so echo, you know, sort of maybe slow down and make sure that you get that right, so you don't have to go out with a document that you're not happy with. There's a question here. The question is, for outside counsel, do you recommend doing an RFP? And maybe I'll broaden that a bit to just say, in general, for outside advisors, do you recommend doing an RFP? I'll speak to the counsel piece first. You can absolutely do an RFP. I would also recommend, you know, speaking with your connections who have gone through an IPO. It's not like you have to invite every law firm out there, right? You can figure out what worked well, what didn't work well, speak with your connections, go through an RFP process. And it's something we do, obviously, from the law firm side on a regular basis, participate in those. Maybe Jesse, from in terms of other outside advisors, what would you recommend there, just process-wise, getting them engaged?
Yeah, I don't necessarily think you need to go through a formal RFP. I think it's a combination of RFP and what you said, just engaging with your colleagues and networking and figuring out who those right service providers are. I would say doing, kicking the tires on all service providers, existing and, whether or not you're going to keep the existing one or go to a new one. So, I think Counsel, talk to a few, make sure it's the right counsel. It's got to be the right counsel to get you through the IPO, plus continue in the post-IPO world. I think, your audit team, making sure your existing team is ready for the next stage. And that can come through an RFP or just a again, kick the tires, be very transparent, communicate, here's what we're going to do. Are you guys ready? And then on the insurance side, another key party, making sure you've got the right broker that can take you from private transition into public. So I'd say, at least a loose RFP on all service providers to make sure everybody's aware and everybody's ready.
I think that all makes sense. There's another question here, and I'm not sure how much experience this panel has, but let's ask the question anyway. So how should private non-US companies compared to US companies prepare for their IPO? And I'll start on the legal side. There's quite a few similarities in terms of your SEC filing. It's instead of an S1, you file a form F1, but a lot of the disclosure actually looks quite similar. Where you will see a significant difference, I would say, is in your SEC reporting as a public company. There's certainly scaled back disclosure requirements for foreign private issuers compared to domestic issuers. Janine, I don't know if you want to comment on it from an audit perspective too.
No, I was going to say the same thing. I mean, when you think about financial statement requirements and what's going into that filing, it's not all that different. I mean, you may be working with a different set of standards, and you have the same, sort of review and audit requirements. So it's having the right providers involved. And I know a lot of the bigger firms, they have incremental reviews of those documents at a layer outside of the audit team that are reviewing anything that's filed. So that could be another layer to just work into the process. So it's just talking to your auditor about that from a timing perspective, but the nuts and bolts really not that much different than what we've been talking about.
Right. Mike, do you see any difference here from a Dino perspective?
The carriers prefer S1 filings over F1 filings. We track litigation trends, and so they're going to be concerned about financial control, something that I think near and dear to Jesse's heart. And we've seen it may not be always practical or reasonable or possible, but we've seen a number of companies in anticipation of doing their filing shift from a foreign filer re-domiciling in the US so that they can do an S1. I understand we need quite a large business and that's not always possible, but that is often a consideration or discussion with the advisors if that's even something worth considering.
Right. The other thing I did not mention, but there's also sort of some of the governance rules under the stock exchange rules are different for foreign private issuers, or I should say foreign private issuers have certain exceptions that they can rely on in terms of director independence and board committee requirements and the like. So while the filing with the SEC might look fairly similar, there are other sort of governance things and other things that look different for foreign private issuers. I think we have time for a couple more questions. Another question from the audience is, what are some examples of how employees should be educated for both IPO prep and what it means to work for a public company? This is interesting, right? And it ties into sort of how do you keep the confidential and sort of tight knit, because often you want to avoid a risk of a leak until you have filed your registration statement publicly. Jesse, maybe I'll kick this one to you too. What are some, I guess, recommendations there?
Yeah, I think I think you said it well too, and it's a balancing act. So I think identifying very specifically who is in the know early on, and at what stage you open it up, and being very specific with that team and how it gets communicated to anybody else. And when you do open up or expand that group, again, communicating very clearly. The other piece is back to that, Reg FD and external communications. I think this was a big one to get communicated to people, in that what you could say or could do as a private company, you can't do anymore. And here's why, and here's examples of what you can and can't do. That's a big one. I think insider trading, what does it mean to be listed and have a stock on the markets? And, a lot of people are new to this and don't quite understand. So I think, just very basic stuff that just being very transparent and, what it means to be a public company. I think those are the big ones. I think just in general, equity communication. What is an option? How does an option work? What's the difference between that and an RSU? What does it mean when that option, as a private company flips to a public company option to acquire public company stock? A lot of times they go through a split or a reverse split to get the pricing right, which adds another whole layer of confusion. So again, working through what that means and how the value does or doesn't change. So it's a lot. And again, I would not underestimate the level of effort needed to communicate to the employee base.
Yeah, I was just going to add on to, you probably want to think about, if you don't have social media policies, educating your employees and putting in a social media policy. I've seen a couple oops messages on LinkedIn and things like that, where just folks didn't understand what could be posted versus not from a confidentiality perspective.
That is huge, and I wouldn't say a common mistake, but something we certainly advise on all the time to avoid what can otherwise be a costly mistake. So I think we're actually out of time here. So apologies to everyone whose questions we didn't have a chance to get to, but I'm of course happy to follow up with anyone after this panel, so feel free to connect. And thanks again to all our panelists. This has been great, and thanks to the center for having us. Really appreciate that. So I think over to you, Colin.
Thank you so much, Victor, and thank you all for sharing those incredible insights on preparing for your IPO.
Great, thank you.
Thank you.
Thanks so much. So now it's my pleasure to now invite our next special guest. Nicola Corzine is the founding executive director of the Nasdaq Entrepreneurial Center, and we're joined by Jennifer Siebel Newsom, first partner of California, award-winning filmmaker and advocate. Nicola, welcome, and over to you. Looking forward to this.
Thank you so much, Colin. I am incredibly excited to be hosting this conversation with Jennifer Siebel Newsom today. As a thought leader at the forefront of changing society's limiting gender stereotypes and norms. Now, Jennifer wrote, directed, and produced the critically acclaimed documentaries Misrepresentation, The Mask You Live In, and The Great American Lie, as well as the upcoming documentary Fair Play. Since becoming first partner, Jennifer has championed issues relating to raising healthy, whole children and in advancing gender equity. In 2019, Jennifer launched #EqualPayCA, an initiative to close California's pay gap. And in 2020, Jennifer co-founded the California Partners Project. This is a nonprofit focused on supporting women's representation on boards and helping communities better navigate the impact of media and tech on their kids. Jennifer also founded the Representation Project, a nonprofit that uses film and media to catalyze cultural transformation. Jennifer graduated with honors from Stanford University and Stanford's Graduate School of Business. And now, without any further delay, Jennifer, we are truly thrilled to welcome you to our virtual stage today.
Thank you so much. I'm unable to start my video. Oh, there we go. Hi, everyone.
Hi.
Okay. Hi, thanks so much for having me. Thank you, Nicola, for this opportunity, for the center's terrific work empowering women and male entrepreneurs who create innovative new businesses and fuel job creation. So some of you may be curious as to why, with all that's going on in the world right now, that I have devoted so much time and energy to championing diversity in corporate board leadership. I mean, what difference does it make to people beyond that elite pool of corporate executives? I believe that solving the massive challenges that we face as a nation and as a planet requires both corporate and government leadership. Now more than ever, the private sector must step in and make decisions that impact all aspects of our lives. And it's imperative that we have more women, especially mothers and women of color, at the tables where those decisions are being debated and addressed. Including more women on corporate boards drives economic growth. It improves the bottom line, and it helps close these persistent gender and wealth gaps while encouraging a more holistic ESG approach to doing business. And let's not forget that prior to the pandemic, women made up over half of our workforce, and they still control 85% of consumer spending, yet their voices are often sidelined. In California, thanks to our groundbreaking legislation, more than 1,100 women have gained access to roles that will shape what companies prioritize and help those companies with their competitiveness, their growth, and their preparedness to meet the immense challenges of the 21st century. These businesses really are shaping the world, and that's why I'm here today as a champion for gender equity, to urge all of you in this community to build the most diverse, modern boards that will result in more equitable and fruitful policies across the private sector. And I'm here as first partner of California because we need California businesses to succeed. And this is the surest way to guarantee that and to set up our state and our country for a more prosperous and sustainable future. So I want to congratulate all of you who are making the leap to going public, and I wish you the best.
Oh, Jennifer, that is absolutely amazing. Thank you so much again for all that you've been doing at leading in this field. Now, California Partners released a report today around how things are going with this regard. What did the report surface? What did you find?
Okay, great. Well, let me just take a step back and kind of give you the landscape that my work historically has been in the gender equity arena. It's about creating equal opportunities for women and girls. It's the through line of my work as a filmmaker. Some of you may, or your children may have heard of my first documentary, Misrepresentation, and the organization I launched to awaken consciousness and shift negative attitudes and behaviors around limiting stereotypes and transform culture. My first documentary, again, Misrepresentation, and then the Representation Project. And then most recently, I actually made a documentary that it's not out yet, but it's my fourth documentary on gender inequity that looks at the invisible work that women have historically shouldered, from childcare to domestic work, but also the emotional load and the mental load, which I think the pandemic actually drew a curtain back on all of this and exposed how much women have shouldered and how much of a challenge it is to women as they climb the career ladders when they don't have partnership at home and when they don't work in family-friendly, partner-oriented companies. So that's sort of been my historic work. And then as first partner of California, my two focus areas have been gender equity and child well-being. And so we've made commitments from the get-go to close the pay gap in our state and make strides to ensure economic equity, representation, and family-oriented policies. And then, yes, as a citizen and working mother, I co-founded the California Partners Project 2 years ago, really at the beginning of the pandemic with Olivia Morgan, my good friend, with the goal to improve gender equity in the workforce in California and to start measuring and understanding the impact of California's landmark legislation, SB 826. And the law required that public companies headquartered in California include at least 3 women on boards of 6 or more directors by the end of this year. And so we've been tracking the addition of women to these boards and then exploring what more we can learn from the California experiment. And obviously we've been encouraging companies to follow suit. And so the bottom line and what we found with this report that's so exciting is that the California experiment is working. California companies realize that there are plenty of talented women for their boards, that all male boards are essentially a thing of the past. And in fact, women now hold almost 30% of California's public company board seats. I mean, that's a tipping point. It's really exciting. It's an increase, as I mentioned earlier, of 1,100 board seats in just 3 years. And so today, because of that, over half of California's public companies have 3 or more women on their board. And it's important because it means that companies have a critical mass of women, which is essentially that it creates, when you have a critical mass, there's an environment where women are no longer seen as outsiders, and they're able to influence board discussions substantially. On top of that, because I'm so committed to addressing the pay gap and the wealth gap, compensation for a director of a public company board is about $200,000 annually. The numbers have kind of, surfaced around there. And that means that's over $200 million a year of new personal wealth in women's pockets, which is extraordinary. And given my background, I worked overseas with women in Africa and Latin America before. I did a lot of micro enterprise work, again, all before Stanford Business School. But what we know is that when you put money into the pockets of women, they invest more in their communities and they invest more in other women. And so that's really exciting. There's been so much progress. One of the things that we did uncover that's not as optimistic, but that gives us, direction and clarity on where we need to work, is that women of color are still very much underrepresented compared to their percentages of the population and the workforce. So Latina women in particular, they hold obviously, there's a huge gap there and an opportunity to improve on these numbers. But, with all of this work that we've been doing, we're helping sort of deepen the understanding of the benefit of having more women in these seats at the tables of power.
Congratulations. What a good step. Still a lot more to go, obviously, and we wouldn't expect it any other way. You've already touched on this, but I'd love to invite you maybe to go a little bit deeper in talking about the why behind the imperative of this initiative. Why is it not only important for our women, but for businesses and honestly this country as a whole, Jennifer? And perhaps with our entrepreneurs present, what entrepreneurs should be thinking about as they create their boards of the future too?
Of course. No, I mean, companies with diverse boards perform better, period. There's study after study after study that indicates this. Including women on your board leads to better decision-making, greater creativity, productivity, and a better bottom line, period. We've known this. We've known this for decades. I've been talking about this for decades. So none of this is new. I just think people are woke to it right now, and they're jumping on that train, and it's smart. And that's how you stack the odds for your success. Is in the beginning, you want to have a truly diverse board before you go public. Obviously, it's a requirement in California that we have diversity on our public company boards. And I like to think that gives our companies a competitive advantage. We're early adopters out here, but everybody can get in on the secret and you can benefit by following the California model. But we do, again, organizational psychology studies, corporate governance experts, and financial service firms like Citi, Credit Suisse, McKinsey, and the Carlyle Group. They all are proving over and over again the benefit to having diverse boards. And other kind of, again, statistics information that you probably have heard is just that board diversity enhances their board's performance and it improves strategy and risk oversight. So, it's a win-win, right? And, I love that there are companies like Goldman Sachs that literally will not take a company public without women on its board. And I think that's a trend that's gaining momentum. And, again, as I mentioned earlier, the earlier you focus on diversifying your board, the easier it is, both in the short term and the long term, and the more beneficial it is to your company. One one example that I love is a friend of ours, Stacey Brown Philpott. She's the former CEO of TaskRabbit and a highly sought after board of director who sits on the HP and Nordstrom's board. And she shared with us that she's more inclined to bring her expertise to a board where she can tell that the company values diversity and isn't recruiting her as a, check the box exercise. And then there are other companies like PagerDuty that went public in 2019 and shared with us that they're taking diversity so seriously and have been so deliberate. And it's really helped them hold themselves accountable for continuing to hire a diverse workforce at all levels, which really has led to true innovation as a company. So, companies across California from WD-40 to data center company Equinix, they're making it a priority and they're reaping the benefits. And I just can't say enough positive things about that. One other thing is, though, it does, as we know, you diversify your board. What we're seeing more and more is that it's improving your company's relationship with key stakeholders, including obviously your employees, but also your customers and your investors, which then improves your access to talent and capital. And over the long term, that obviously only will increase your company's chance of being sustainably profitable.
Well, on those incredible words, the sustainable profitability, for all those that you've motivated with the reasons why they have to lean in and say now is the time, how do they get started? What's the advice that you'd give on the first step to take?
Yeah, well, look, if you go to our website, we have a great resource hub, the California Partners Project website. We have a great resource hub with dozens of organizations that can help you find fantastic women candidates, and it's truly worth your time. They've done their work, they're invested, they're committed, and they will be your allies on this journey. We also have, through my alma mater, Stanford's Graduate School of Business, an awesome playbook that helps you be intentional in your recruiting. And what we've learned, which is really, I think, illuminating and important, is that if you aren't deliberate about your recruiting, you will subconsciously raise the requirements bar for women and lower it for men. So this is like a cognitive bias that we can't help unless we building processes that actually force us to hold that bar steady. And I look forward to sharing that playbook with all of you as soon as it's ready in the spring. But essentially, you have to get started early, right? Once you have a few women on the board, it's that snowball effect or that flywheel effect where adding another takes less effort because of the networks that these women bring to the table, but also because of the tokenism issue that I mentioned earlier. And then the other thing that's important, I mean, just a couple other tidbits that I think are important to share is that when you're asking people to help you build your board, you really want to focus on skills, not titles. I think we're so stuck on the titles trap of just bringing in another CEO or CFO, but there are so many other skills that are needed to help mitigate risks at the board level, like risk management, cybersecurity, human resources, marketing, and public affairs. And having spent a time recently, obviously in government and formerly as well in the nonprofit sector, not just on the entrepreneurial side, I do think that those who have always focused on sort of the triple bottom line model or the social good or the public benefit would add value to any company board. And I don't think there's been enough work on looking at who those players are that can help a board really ensure it's committed to the social bottom line, the environmental bottom line, not just the fiscal, obviously fiscal being of utmost importance. And then something else that's important to mention is that boards tend to overestimate the risk of adding women and they underestimate the risk of groupthink. And so I find that really interesting. And it proves that adding fresh perspectives to your board, it's an opportunity, it's not a risk. And then lastly, just again, we all have these networks and they're quite insular. So you have to keep thinking about, you constantly have that recruiting mindset. I was at dinner last night for the first time in a public venue with some friends, and in between my bites of food and putting my mask back on, it was really, a friend was telling a story, and I was like, oh my God, her husband would be so good on one of my nonprofit boards. And it never occurred to me. And I was like, oh, because she was giving us a story about her feminist husband and how he did this cool thing when he was on a board in India. And I just thought that is so phenomenal. So I share that only because, I forget, like, there's an opportunity to constantly be, have that recruiting mindset. And that is important, especially with networks that include women of color.
I love that.
So anyway, go to our website at the California Partners Project, look at our resource hub. They're incredible organizations that we partnered with who can be resourceful. And then I can't wait to share the playbook with all of you in the spring.
Oh, we're going to be staying tuned for that, without doubt.
Yeah.
I can't believe we're almost at time, but before we let you go, we always ask this, and I can't wait to hear yours. What is a key takeaway that you want all of us to leave today, knowing or thinking about from the incredible experience that you've had behind you over the decades of really being at the forefront of change in this regard?
Well, look, women are 51% of the population. We are underrepresented in most industries in leadership. The pandemic has set us back 2 decades in terms of our representation in the workforce. Women have unique experiences and perspectives and intuition. They're essential in leadership positions and in the C-suite and corporate boards. Their perspective, their voice, their stories are essential. They've spent enough of their life juggling and not sort of in these siloed boxes, thinking about, everything from, what they put in their children's mouths and on their bodies, to how we're educating them, to, how we're handling, especially now, this influx of data and technology at 24/7, infotainment cycle that, nobody is sort of removed from or protected from. And there's this long-term sort of, again, intuition and commitment and perspective to not just leaving the world in a better place, but it also just stems from this connection with care and this world of care that we've all I think really become awakened to as a result of the pandemic. And, clearly, from my perspective and orientation, the more companies care and see the humanity in their workforce and in their consumers, the more you're going to be developing products that ultimately are going to have a long shelf life and be a part of, ensuring the company's long-term sustainability, but also, greater, again, relationships with investors, employees, and consumers. And so it's just a win-win. It's worth prioritizing. It's worth, taking the time to get it right. And, I can't say enough for what this can do for our society. Again, government can't do this all on our own. We still haven't reached parity, gender parity in this country. And because, historically, women have not had seats at the tables of power, I'm excited for all of you to see what they bring to the tables of power, because there's a lot of learning and there's a lot of wisdom there that will only better your company over the long run.
Jennifer, thank you so much. It really has been an honor. Thanks for inspiring us to lean in and do even more, and for all the incredible work that you are leading. It's really amazing.
No, thank you. And thanks to your commitment to innovation and to building the great companies of tomorrow. I wish you all the best, and I look forward to seeing what you guys all do.
Amazing. Thank you.
Thanks.
So you have just heard from first partner Jennifer Siebel Newsom on the incredible work that is being led by California Partners Project. We're going to be popping into the chat box a link for you to be able to access that report that she referenced today, along with all of the other incredible resources that are out there. And you can visit their website to learn more at any time. We are committed to this at the center, and all of our partners joining us today believe in the imperative nature of what Jennifer was talking about. And we're excited to be on this walk with each and every one of you. Again, thank you so much for joining us, Jennifer, and to California Partners Project for your leadership. And now back to you, Colin.
Thank you. Oh, exciting, exciting, hot off the press news on the reports. Up next, we have our panel of experts who are going to share on how to execute your IPO. Friendly reminder, we're going to continue the Q&A at the end of the session, so submit your questions in the Q&A function at the bottom of your screen throughout the discussion. As you settle in, we wanted to get a better idea of who we have joining us for this session and what you're looking to learn. So I'm going to launch a quick poll. So in the next 12 to 18 months, are you planning on starting the IPO process? Are you headed in that direction? Are you yes, but not within that time frame, or not quite yet? Appreciate all of you contributing. This will help our panel drive the discussion. Alrighty, so I'm going to share those results real quick. Looks like a lot of people are headed in that direction, so it should be great timing for this content. So without any further delay, please join me in giving a warm welcome in the chat to our special guests. Our moderator for this discussion is Jack, who's the head of US listings at Nasdaq. We also are joined by Mike, who's the CFO at Allbirds. And we also have Liz, partner and founder at Class B Group. Welcome, everybody. Jack, over to you.
Thanks so much, Colin, and great to speak with you all. Again, my name is Jack Counsel, and I'm just going to kind of quickly level set before we jump into some of the questions with Mike and Liz. But, you know, it's been an incredible year as we think of the U.S. capital markets. At the beginning of the year, we were on the heels of a great 2020. And there was a lot of momentum, and there was a bit of just cause for not necessarily concern, but just everybody was wondering, will this continue into 21? Is there enough appetite, or are there enough quality companies still left in this pipeline? And wow, was that an understatement as we look at where we are here in December. So as you heard on kind of some of the earlier reports and numbers, a great update with the first session, but we have eclipsed the 1,000 mark for total IPOs in the US this year. And that's with companies raising over $350 billion in total proceeds. Also in Q3, we saw the close of, there was about $100 billion of private capital deployed, putting us at close to 500 million in 2021 on the private side. So from a timing perspective, companies have a lot of options to consider. And another element of this, as we've seen and you'll hear, is the game is changing, or at least evolving when it comes to the traditional best practices. So the rules that had been unchanged for decades have now seen an evolution over the last 12 to 18 months as companies are really reimagining the structural details, the pricing strategy, price discovery, even the investor allocations to achieve more equitable pricing and improve shareholders or that base building. So that's just kind of a quick observation of the year. And without further ado, we're going to hear from two of our experts that have firsthand experience in actually taking companies through this exciting path from private to public, and how to best prepare you and your respective teams for success in 2022 or whenever the time is right. So to kick things off, we'll do a quick introduction, and maybe, if I may, just ask for a kind of a high-level background as well on your career itself, and then how you landed for Mike at Allbirds, and then Liz will go for you at Class 5. So Mike, I'll turn it over to you.
Thanks, Jack. It's good to see you again. It's been a few weeks since we've had a chance to catch up, and welcome everybody. We're excited to be here, and I'm excited to talk to you today. I was actually just reflecting. So I joined Allbirds in January of this year. So I've only been with the company for about 11 months now. And around this time last year, I actually sat through a similar version of this webinar myself. So talk about good planning and really helping you think through some of the issues around a company going public. Before Allbirds, I had spent 10 years at Panera Bread, the last 5 as the CFO there. So the company was already public when I got the CFO role. So I'm used to life in the public markets, but going through an IPO is a totally different experience, to say the least. And before Panera, I had spent 9 years at PepsiCo. That's where I started my career. So I've kind of gone from a giant company that honestly serves a lot, sells a lot of really fun products, but not necessarily great for the world, to now a company that's, much smaller and, much earlier in its life, but really tries to do a lot of good in the world. And excited to talk to you all about the journey today.
Great. Thanks so much, Mike. And Liz? Oh, Liz, I've got you in the double mute there.
Wait a minute. There we go. You'd think maybe by this time in this whole pandemic thing, I would have learned about that mute button, but I spent a bunch of years as an institutional investor for T. Rowe Price. And at the time we were the largest dedicated technology fund. So every tech IPO that came by basically had to get past our toll gate, if you will. And so I saw an amazingly large number of IPOs and was pretty quickly able to see what distinguishes the ones we really wanted to own from the ones we wanted to own for the first 37 seconds to the ones that we were going to pass on altogether. So great, thought I knew a lot about IPOs, but ended up leaving the buy side and going to work for an investment bank and saw the process from the perspective of the bankers. And it is totally different than the perspective that you get when you are the institutional investor. Fast forward a few years, decided it was time to become a venture capitalist. So did that for a bit and got to see the IPO process from the perspective of the board. And once again, different motivations, different things that matter the most. And finally, I decided that to be really good as a VC, I should probably go to work for a company and see the IPO process from the inside. And so I actually joined a small search engine company in Mountain View to work on their IPO, and that company as a project manager, and that company wanted to do something different than anything that had been done before, which required me to take the whole IPO process apart bit by bit by bit to figure out what's done one particular way because it has to be, and what's done that way because that's just the way the deal before it was done. And having then seen the process from the perspective of the buy side, the sell side, the board of directors, and as a project manager, recognize that management teams know their business incredibly well, but they don't know the nuances of the IPO process. And so, sorry for this long-winded intro, but so that's when I set up a consultancy to work, literally to work as a caddy or an aide de camp for management teams, to serve no other master, as we'll get into later, as many advisors do, just to help management understand all of the nuances and control the process they best they could. So, long-winded answer, but there it is.
No, and that, for both of you, that's what I was looking for, because again, this audience is a collection of a variety of different departments, but also a variety of different stages. So there's a lot of, senior people that are looking at this for the next, 6 to 12 months. They might even be in process now. But then we also have a group of the audiences saying, hey, if, when I grow up, I want to be just like Liz and Mike. How do I get there, and what were the steps to achieve this level in their careers? So that's very helpful. So this is a question for both of you, but a lot of people are calling it the year of the SPAC. I mentioned there were 1,000 IPOs this year. About 60% of those, so 600 for round numbers, have been SPACs. But that also means that there's been a little over 400 traditional IPOs, which again is just an incredible high watermark as we look back at the historical years. So Mike, I'm going to start with you on this one, but if you're a late stage company and you're starting to think about a public exit, what are some of the challenges and execution risks that teams should be thinking about?
Yeah, so I think the first thing is, if you're thinking about a public exit, it's really helpful to step back and go back to first principles thinking. So what do you want to accomplish with that exit? Is it solely a financial transaction? Is it a financial transaction to take care of early investors who want to get out of the investment? Is it a way to help your employees along the way, right? People who sort of made a bet on you early on. Like in the case of Allbirds, it was a lot of those things for us, but honestly, it was also, we realized, as a brand that's only about 5 years old, We have 11% aided brand awareness in the US today. So by having a partner like Nasdaq, not just to say nice things about you and the team, Jack, but by having a big listing day and having a big event and doing something in Times Square and getting a lot of media coverage, it could also be a big media moment for us. And we'll talk later about some of the other things we did kind of unique around our sustainability mission. So I think really the first question to ask yourself, go back to first principles, what are you trying to accomplish? Because then some of the pieces of the execution risk will become more clear or not to you when you have those end goals in mind and you're sort of building your process towards that. Beyond that, I do think you can't really underestimate the internal readiness stuff. Like I said, I joined the company in January. My predecessor here at the company did a phenomenal job of building a team, building processes. We have SAP in place. I mean, all of these things that you sort of take for granted when you come from a larger company, having a lot of that in place and having that built, I think was really, really important. And that certainly mitigates some of the execution risk. The last thing I would just say though is prepare for the fact that it's going to be a bumpy ride. I kept using the analogy with the team. We got in a car in San Francisco and knew we were driving to Phoenix. We had a good sense that we were going to get to Phoenix, but a whole lot of things can happen on a road trip from San Francisco to Phoenix. So be prepared that stuff's going to go a little bit different than you expect. And that kind of goes to some of the execution risks, because there's some risks you can control, but there's things you can't control along the way. And you have to make sure the team understands that ahead of time and is ready to be resilient and respond when things don't go exactly the way you expect in the process.
Yeah, well said. And Liz, I'd love for you to follow up there.
I would just say that was great advice. The first thing I will always ask any potential client is, why do you want to do this? And the second question is, why do you want to do it now? Because it is an arduous process. And as Mike said perfectly, the more you know why you're heading down that road, the easier some of the bumps along the way will be. And there will be issues like right now. We have a pretty volatile market, and it's a little nerve-wracking, frankly, for companies that are near the pricing part of their transaction. Why are you doing this? And do you want to put it on hold if things are bumpy? And anyway, so it's great advice. Be very clear on what you are trying to solve for. And there are lots of good reasons to go. Just know what yours are and make sure, frankly, that your board is aligned with those. And I don't know, Jack, if your question was you started by talking about SPACs, but do you want to hit that later, or do we want to jump into that?
No, I'd love, let's go ahead and hit it. It's the topic du jour of the year. And again, I think it's a lot of companies, obviously we've all seen this, it's now become an option, right, as a path to the public market. So maybe Liz, I'll go back to you to start with on kind of what you're seeing and your perspective on it.
Yeah, and I'll just throw in at a high level because it ties back into why are you going. The process you choose should align with your reasons for going. If you're literally just racing to get out the door and less, frankly, interested in how the future is going to play out for you, then SPAC is an answer for you. But generally speaking, they aren't the answer for most companies. And the rhetoric around SPACs, that it's easier and it's quicker and you'll get a higher valuation, it's nonsense if you look at the data. There was a brief moment in time where people were investing them without, frankly, doing the incremental homework, and where companies were maybe getting out a few weeks earlier, but that day is long gone. And so whatever process you pick, and again, we can get more into the differences later, but make sure that you can differentiate the rhetoric from the reality, because 180 degrees apart.
Yeah, well said. And again, we're seeing a lot of these deals get delayed. And I will say it is right for certain companies of a certain brand, of a certain profile. But I think what you both nailed on the head is it has to be right for your specific company, right? You have to have those different check boxes and it making sense. And that's where we've seen a bit of the slowdown on the combination side, not necessarily the new issuance, but those actual deals getting completed here in the 11th inning.
And
so Mike, maybe to you, or sorry, go ahead, Liz. No, please.
I was going to just to put a little bit more direct, how do you know if it's right for you? Generally speaking, there are exceptions, but generally the companies that have chosen the SPAC route are those that don't want the same amount of scrutiny. and there's some reason that they don't want the amount of scrutiny, whether there was some trouble in the past that they just don't want to rehash, whether frankly it's a flying car where it's a roll of the dice and you just can't have the financial proof of anything, frankly, yet. Mostly the companies that have chosen the SPAC route are those that public investors would consider to be significantly more risky than those that are willing to go through the actual process. And we've seen the evidence of that in how some of those companies are trading once the de-SPAC has completed. And I'm sorry, I didn't mean to interrupt you, Mike.
Oh, that's helpful. And Mike, I'm just going to throw it over to you. Just to, I'm sure this was contemplated. Maybe it was a long discussion, maybe it was a short one, but maybe share kind of your experience with it.
Yeah, I think for us, I mean, for so much of what Liz was just saying, like it didn't really make sense for a company like Allbirds. And I think for us, one thing that was really important was in our prior rounds of funding, we had attracted the T. Rowe Prices, the Franklin Templetons, the Fidelities of the world. We had a really strong investor base already in the business from our private rounds. And a lot of those are crossover investors. And this has really become something that's become much bigger, especially in the consumer space, really over the last 5 to 10 years. These investors that get in earlier with a company, start a low like cost base kind of in their holdings on it, and then carry over with you into the public markets. So we didn't want to risk that, at all in our case. So a SPAC really never made sense. One of the things I'd really ask people to kind of think about, and really, I just want to kind of go back to what Liz was just saying, is like, this is a transaction. It is a moment in time, but then you are in the public markets. You are a public company. You have to be ready to be a public company. You have to have predictability of results. You have to have a clear strategy. You have to have a clear business plan that then translates into those results. You have to be able to give guidance. You have to be able to have disclosure. You may kind of get around some elements of disclosure at the time of the transaction, but you still got to file your Qs. You got to file your Ks. Like you have shareholders. Like this is not just sort of a quick hit thing. And it really takes, I was fortunate to work at 2 great public companies before Allbirds. What really made those companies unique was how well tied the financial results went all the way back to the strategies of those companies and how thoughtful and consistent it was. And these are companies that created shareholder value, quarter to quarter, but really year to year, 5-year chunk to 5-year chunk. And that's what helped them succeed over the long term and create a whole lot of shareholder value. And I think you have to be treating this transaction like that, not just what your plan for the day you get to ring the bell, but what's your plan for, the first 6 quarters after for sure, but really the first decade after, where do you see your business going? That's what will differentiate it and make you enjoy life as a public company a lot more.
That's very well said, Mike. And, I'm going to stay with you for a minute, just to highlight something unique that Allbirds did. And when I wanted to cover this in general, but when you mentioned kind of that 10-year out and how you envision the brand just evolving, can you take a minute or two to just explain to the audience the SPO? I don't know if anybody caught that earlier, but a sustainable public offering. And then specifically, why Allbirds kind of chose to emphasize that framework as part of the public offering.
Yeah, so what it is, so folks know, is, as we made the decision to go public, we knew one of the things that differentiated us from a brand and company perspective was our sustainability mission. So we like to say we're a purpose native business. So 15, 20 years ago, people talk about being digitally native, and now kind of everybody's digitally native if a company has come together, in the last decade or so. For us, really, as a consumer business, being purpose native really matters. Our purpose is around sustainability and helping to reverse climate change. Now, tied to that is the fact that we also knew from the types of investors that we had already attracted and wanted to attract into the future, those tended to be the investors who are going to be most focused on ESG, and the ones who really want to differentiate between just I'm checking a box around ESG and I can say I have an ESG holding in my fund, versus like companies that truly were authentic and credible when it came to ESG. So as we set about doing that, it started the way a lot of these things do. As I was reading a presentation from one of our banking partners about the possibility of an Allbirds IPO, and this phrase green IPO was in the presentation. And I slacked our head of legal and I was like, hey, is there a definition of green IPO? And he's like, oh no, that's just like something the banks like put in the presentations, but no one's helped them define it yet. And they haven't had the right first issuer to do it. And that was the genesis for us of the sustainable public offering. And what we ended up doing was putting together a framework with an outside advisory council that really go across 6 categories, has 19 criteria, either about what your transparency is going to be about your reporting on ESG, so what's already out there in the past, what you've already accomplished or what your commitments are over the next couple of years. And what it was really designed to do was show a clear framework to investors what a company at our stage, so late stage private, going public, early stage public company, can be differentiated when it comes to ESG. Because the reality is there's a lot of great ESG rating systems, but this space is evolving really, really fast right now. And none of it today is built for companies in our stage. So that was the genesis behind it. When I step back and all of that, we're thrilled with how it ended up working, Jack. We look at our roadshow. We ended up meeting with 43 investors. We converted over 90% of them. We had 43 meetings, probably about 500 investors. We converted over 90% of the people we met with. We were way oversubscribed for a relatively small deal. The stock, we ended up pricing it above the initial range. We upsized the deal a little bit. So that told us that we really were able to show to investors that this core mission we have and how it ties to ESG didn't just make us people who were doing good for the world, that we were going to be a good investment and a great public company. And people saw that and how tied in it all was for us.
Yeah, well, and I see our firsthand just compliment you and the team on what you've created, and we've been thrilled to be part of that. Obviously at Nasdaq, we also have been leaning in heavily over the years in ESG, and it's really great to see now this next, again, evolution, as I've said a few times, but it really is this continued evolution of the process and what you created here for the next cohort of of companies coming to market that are going to be able to leverage this, that also are mission driven. I think that was something that resonated not only with us in our particular relationship, but we also saw from your broader investor base is how you're not only talking the talk, but walking the walk. And that's what's so incredible to have from a company perspective. There's a lot of people, again, out there trying to check boxes to get credit for things they haven't done yet or kind of selling futures, but Allbirds is one of the few that has really put its money where its mouth is and is executing. So congrats on that.
We appreciate that, Jack.
Sorry, Doug.
Yeah, no, one thing I would just add, and we really appreciate that. One thing I would add too, we ended up then, we felt like we knew we couldn't just sort of like create this on our own, Allbirds. So we worked with BSR, and we recruited a group of advisor counsels, so experts across investors, experts in each area of ESG, and folks from the two, big ESG ratings agencies. And they created this framework, right? So it wasn't just an Allbirds framework. So it was very much, to your point, Jack, meant to apply then for other companies who come behind us. So if you go, I think it's bsr.spo.org or, vice versa. It's been a couple of weeks since I've been talking about it a lot. We're back to like life running the company, but I really encourage you to look up what we did there. And I think the criteria really can apply to a lot of different businesses. And, we'd be excited. My head of sustainability and I would love to kind of get on a call if anybody is interested in learning more, because we definitely are being, evangelists for this, because we do think it's a great way for companies to differentiate themselves if they really are, purpose driven like Allbirds is.
Absolutely. Well, that's great. And I've got, Liz, we're going to slightly transition now. So we've got IPOs, we got SPOs, we've got some SPACs. And we couldn't do an IPO Bootcamp without asking you about direct listings. So we've, yes, the D word. So we've had 6 now this year, right? So we kind of went from 1 to 2 to now 6 this year. You've had experience with a few of these. I'd love to get your perspective on this, and how should the audience be thinking about this as a third, I guess, path to the public market?
Which I will get to in one second. I want to point out one other thing about what Mike just said. They wanted to do something that was super important to the fundamental mission of the firm, and they did something different in the IPO structure. And I don't know what the experience was, but generally speaking, when a company wants to do things differently, the initial reaction from the investment banking community is, oh no, you can't do it that way. That's not how it's done. And the lesson all across the board is, this is your company. You have to live with what you did. And if you want to do something different, you just map out what you want to do and stick to your guns. Because again, no one had done an SPO before Allbirds. And now you'll hear the bankers pitching it in the meetings. Oh, it was our idea. And of course you should do this. Point is, it is your process. And if there are things that are particularly important to your company, don't let anyone talk you out of them, assuming that, they're within the regulatory boundaries. But
Liz, I haven't learned how to do a Zoom high five, but I'll give you a sort of like my hand towards the camera a little bit. Everything you just said applies to whatever is important to you in that process. It's your company, it's your transaction, and you have to do it in a way that's true to you. And the answer is always going to be no, because this is a machine, right? 400 IPOs, it's a factory. And our banking partners are great, and they eventually got on board with it. But they're running a factory. And if you know anything about running a factory, you do the same thing over and over again, and you're really efficient at it, and your margins get better. And when you have to specialize, that's when a factory doesn't work nearly as well.
Yeah, the bankers will eventually get on board with it, but you will face resistance first. So anyway, now onto direct listings. Sort of like SPACs, there's a lot of smoke and mirrors out there. And I should toss out that from the perspective of my business, it doesn't make any difference. I don't have a hound in the hunt. But the rhetoric about direct listings is, well, you don't need a 180-day lockup. I don't think there are any IPOs that have 180-day lockups anymore. That's done. Two, those who are the loudest in speaking about direct listings are also those who are going to be the biggest beneficiaries, because they do have the ability to sell their shares right away. And to the extent currently, since there have been none that are actually primary capital raises, to the extent that you don't need to raise any primary capital, and to the extent that you frankly don't care who owns your stock and don't really care what the opening price is, then maybe a direct listing is for you. A couple of the ones that have gone by have had a great reason to do it. Palantir is a somewhat secretive company, and they were able to be a little more secretive about some things. Asana is a whole different animal, because the largest shareholder is also the founder CEO who from time to time has come back into the market to help stabilize the price. But the song and dance about direct listings is, oh, there's no pop. The stock won't jump, so you don't leave any money on the table. Well, first of all, again, since nobody's done one where they've raised primary capital, what you're really saying is none of your selling shareholders are leaving money on the table. But anybody who's like taken economics 101 knows that there's a line, a graph of risk and reward. And the more risk you take, theoretically, the more reward you should be able to achieve. With a direct listing, let's start again by saying no one knows what the exact right price is for any security until it has started trading. You can estimate based on the comps and what the market's doing, but no one knows exactly what the price for XYZ stock will be. There's always a little bit of mispricing just until we have the data. With a direct listing, the beneficiaries of that mispricing are the people who are risk off. It's the selling shareholders who, again, are not the company. You're not putting this money in the treasury. So the benefit totally goes to the people who are off risk. With a traditional IPO, if there's a mispricing, the benefit goes to the new buyers, the people who are taking the incremental risk. And generally speaking, and again, this is one of the things that makes me nuts about direct listings, the conversation is, oh, there's a pop and look who's making the money. It's all those rich people. No, first of all, you can do a lot of things that we'll get to in a second to minimize the pop if you don't want a pop. But secondarily, the biggest investors in IPOs are Fidelity and Wellington and BlackRock and T. Rowe. It's the pension funds, it's the mutual funds. So to the extent that someone is getting the benefit of that brief mispricing, it's not some, rich billionaire who everyone loves to hate. It's, your local school teachers. I mean, it literally is the people whose pension funds are being managed. So that's thing one. Thing two is many companies actually care who their shareholders are going to be afterwards. And if you choose any other structure, you actually get some say in that. And there is no question that some of the people to whom you would choose to allocate stock will flip it right away. Absolutely. Some of them will. And many of them won't. And I can tell from my days at T. Rowe that when I got a healthy allocation of stock from a management team, I would remember that not only the day of the deal, but going forward. Hey, this is a management team that listened to who we are, that wants us as a shareholder. And that had an impact on when and how we came back into the market for that stock. So direct listings are, again, fine if you don't care who your shareholders are and you're just in a hurry and frankly, your board wants to sell, because of course you also need sellers in order to have stock there. The last thing I'll say on this topic is there has been talk about direct listings with a primary capital raise. That may happen. The liability questions right now are enormous. Somebody's going to go first, and I will guarantee you somebody's going to get their hinder suit off, and then we'll figure it out. Because one of the other advantages of a direct listing is that the company puts out its forecast as opposed to having the investment banks get the forecast from the company and put the numbers out there. And if you are raising money, any statement you make, you have complete liability for. So if you are actually raising money and you put out your forecast instead of the bank's forecast, and then you miss any number in that forecast by $12, you're going to get sued for a fraudulent conveyance. So until the world figures out how you can raise primary capital in a direct listing using your own forecasts rather than the bank's forecast, the liability risk is huge. And I didn't hear the first panel this morning, but I suspect the D&O providers will have some strong feelings about the impact of that on their pricing schedules. So anyway, long-winded answer, but direct listings are not a panacea, but go ahead.
Yeah, no, sincerely appreciate it. And I'd say to that point, both exchanges, Nasdaq and New York, do allow, from an exchange perspective, the direct listing with the capital raise. But exactly to your point, there's just so much hair on it right now from a risk profile that we have not seen the company nor a group of advisors say, hey, this is the one that is going to attempt this. So I think it's something we're all collectively watching closely, but it will be very interesting to see
and it's risk
if we get to a point where somebody jumps on.
Sorry, it's risk and cost, because one of the other things that people advertise about a direct listing is because you have no underwriters, the fees are less because no one is underwriting any stock. And so they're not going to take a risk premium for that. Again, with a direct listing with a capital raise, you do need underwriters. So no one knows exactly how the fees will work yet either. You might have some portion of the transaction would just have advisory fees, which can, but aren't always a little bit lower. And then a separate add-on set of fees related to the portion of those shares that are being underwritten by a bank.
Well said. So maybe sticking with underwriters then, Mike, I'm going to throw it back to you just to give your insights and maybe walk the audience through the process of actually selecting banks and what you were looking for and maybe why specifically you picked the banks you did, the timing. And then maybe a follow-up question to that is there an advantage to rounding out the syndicate earlier in the process, or what are your thoughts on that?
Yeah, I mean, look, it's not quite a duopoly, it's a fiveopoly, or whatever, when it comes to who's going to lead a transaction like this. So you're in a small, set of folks, who would probably be your leads. In our case, we ended up with Morgan Stanley as our lead left. But, as it says in the S1, we also ended up giving the JP Morgan team equal economics for us. And then Bank of America was the third kind of in our lead group. And the way we kind of got to that ultimately was, part of it is like relationships and comfort. Again, back to my road trip analogy, you really got to pick the people you want to be in the car with for a long time. And it's going to be a stressful trip. So there was an element of that. In our case, we have a long relationship with JP Morgan before the transaction. So we really felt like they understood the company very well. Beyond that, what we really were putting a lot of thought into, and this will really tie to any transaction a company does, but certainly an IPO, we put a lot of thought into what role did we want each of our banking partners to play in the transaction. This gets kind of the second part of your question, Jack. We felt really, really good about the team we had from Morgan Stanley, especially on the equity capital market side. So we knew as we got closer to the actual transaction, the connections they had with a lot of the key investors we were after, the advice they'd give us around, pricing, sizing, all of that. We felt comfortable with them in that role. JP Morgan really helped drive us both on this SPO concept and really because they knew our business so well and had known it for so long, they did a really good job of helping us craft the storytelling there. And part of what I really liked about the Bank of America team is they were comfortable sort of flexing across both of those and bringing a lot of the great things their bank does, but knew that they didn't need to try to grab the steering wheel for that part of it, but they were very helpful in kind of bringing the transaction along. Then rounding out the rest of the syndicate for us, we figured as a consumer business that is well known within a community of investors and analysts, we were going to have a fair amount of coverage eventually from analysts. So we ended up going with a bit of a broader syndicate of analysts. So we didn't put, we basically ended up kind of with 3 leads and then a bunch of research banks kind of involved. And it was important for us to have diverse partners as well in the group. So part of what we did there was we wanted to build out a broader group of analysts because we wanted to be able to make sure that we were able to tell them the story It's pretty unique when you're going through this IPO process because you sort of have this unusual moment of like you can share a lot of access and a lot of information with them that you have to slowly turn the spigot off once you're fully out there and kind of in your public, and it changes a little bit. But being able to have like all the analysts who cover us spend a day with us in our office here in San Francisco and meet the rest of the management team, not just the co-CEOs and I, right? Meet the guy who runs supply chain for us at a time when supply chain is a huge concern, right? That had huge benefits for us. That's part of how we thought about rounding out, the rest of the syndicate.
That's really helpful insight. And Liz, I mean, you've mentioned a bit before around controlling that narrative and making sure you get your voice heard in that room. I guess as you advise companies on this selection process, what are some of the best practices or things they should be looking out for?
I would say the single most important piece of advice I can give you is hire bankers, not logos. Hire the individuals who you will meet in the process, who understand your business best, who listen to you most closely. Wall Street will not pay you a 16th of a penny more for your deal because you had X bank and Y bank and Z bank, or X and Y, or it's a fallacy. And it's certainly one that it's in certain folks' best interest to keep that thought out there, but pick the people who understand your story. And who knows what 2022 will hold. 2021 has been incredibly busy, and there are companies better served by having, the A team from bank B versus the B or C team from bank A. So again, you're hiring individuals, you're not hiring a logo, and meet them beforehand so you can see the different styles because they exist. The second thing, and this again, we'll go back to what Mike just said, is it's really good to have two banks at least whose heads are really in the game, as opposed to giving all the control to one bank, because they are busy and sometimes they need to be reminded to listen to management teams. And if you have at least two or possibly more banks in the room that have a strong voice, everyone seems to come around and listen to management a little bit more than if you give all the control to a single organization, whichever organization that will be. And the second thing is, again, pick banks for different skill sets. Some really will do a great job positioning your story, but they may not be the strongest equity capital markets team. I generally like to have no fewer than 3 banks on the top line of any transaction I'm involved with. 1, the big bank, because almost everybody hires one of the big banks. 2, a second bank that isn't quite the big bank, but can nip at the heels of the first bank to keep everybody rowing in the same direction. And then a third completely independent bank, predominantly chosen for its equity capital markets, who will give me the straight up at the end of the transaction about what really is the right price to put on this cover. And do we really want to play a silly momentum game of starting out with a price range that's much too low so we can get lots of people who are only interested because something looks like it's on sale and build a frenzy of people who don't really care? Or do you want to start with your price range where you'd be more comfortable setting it, and what are the risks and what are the rewards? Anyway, I like to have 3 banks on the top line, and then you certainly do want banks who will provide solid research. And Allbirds is going to have research because it's so interesting and everyone knows about it. But if your business is a little more esoteric, you want to be very thoughtful about who's going to cover you after you become public. And the last thing I'll say on that is the big banks get into deals because they're the big banks. The littler banks get into deals because they have really strong research. Many institutional investors listen more to the research analysts that come from the smaller firms than they do from the bigger firms. So it's really important to get to meet the analysts early in the process. The old adage is you date the bankers, you marry the analyst. And that's kind of true. The analyst will stay with you long after the IPO. So if you're thinking about doing some sort of a transaction in the next year, when you can find the time, now is a good time to start meeting the analysts in the sector to see who really is interested in your business and who cares and who asks the right questions and who is like, yeah, thanks very much, but I never cover anything that's under a $80 billion market cap. I don't know. So anyway, it is not an easy process, and it certainly should not be boiled down to just pick the most familiar names, because that will not serve you well.
And on that analyst point too, just something I would share that was really helpful for us is, we were able to talk to some of our current investors, folks who are involved with the company, when we were still private, and get their opinion on the analysts who might cover us, right? Like, okay, who do they listen to? Who do they not? And it's different, to your point, it's very different flavors of different analysts, right? but who is well respected within the population of people that you are already listening to or already some of your investors. I think that's really important to get a good feel for it, and absolutely meet the banks at a time, meet the analysts at a time before you're in the heart of it. And also know that honestly, like the banks also know this, right? So like there are some, banks that kind of sit in the middle of all of this. They're not quite the research banks, but they're not quite the big guys. And in a busy market, sometimes you're not going to get that one analyst you want because the ego of the bankers is a little too much and they need to be in a certain line of the transaction. And again, you got to let that go, right? You got to, do it as best you can and make the trade-offs. And that goes back to like, what are you trying to accomplish with this part of the process and who do you want involved, and do the best you can in building it out.
I'll throw in one more comment because you just reminded me, which was going to be about economics. Because Mike is absolutely right. Oh, I can't be on the line to the left or to the right of that bank. And oh, my font has to be bigger. Like the stuff that banks end up worrying about is stuff that most of us left in the sandbox at, age 6. But they do, it's the pressure that they're under to end up to be there. But increasingly banks will you'll figure out, my advice is always to do a bake-off, because I am always bake-off. I'll interview a bunch of different banks and ask them some questions, because I'm always surprised. Somebody always underperforms and somebody always overperforms, and it's always somebody different. And you learn stuff in these things. But anyway, then my advice is have an A. This is the ideal syndicate, and this is this is pretty good. It's not quite what the first one, but it's pretty darn good, because they can all, assuming your numbers are good and your story is good, they can all get the deal done. When you go to hire bankers, they will all scream and yell that you're not paying them enough. And we never do deals for less than X%, which is fascinating because they look more at the percent than they do at the dollars that you're paying them, which, these are people who are supposed to be good at math, but you can pay somebody 8% of your transaction and it's going to be $2 million and they'll be all unhappy about it. Or you can pay them 10% and it'll be $1.5 million and they'll be like, great. But the argument is, be ready to understand that they're excellent negotiators. These are smart people and they're excellent negotiators. And so have your game plan and then be willing to say no. And sometimes some banks will walk away. I'm sorry, if I can't have that, I'm going to walk away. But you're going to pick a team that is the best team for you. And if you have to drop one to satisfy the ego of another, you might think long and hard about it, because no bank is indispensable. More in the weeds than you wanted at this moment, but.
Well, I'm sure many people are taking notes because they have not had the experience of going through this process once or dozens of times. So I'm sure this is all very well received. Mike, we've got maybe 2 more questions here. Just quickly for you, and for you both, but Mike, I'm going to start with you. Just virtual roadshows, right? We kind of saw that born out of the pandemic through kind of this summer in 2021. We started getting back to in-person events and maybe meeting in person again. But share a bit about Olber, your roadshow. How much was virtual? How much was in person? And what kind of led to those decisions and the effectiveness of that?
Yeah, the only part of the process that worked out we were able to do in person was our analyst day. Those glorious 6 weeks when like COVID was over before Delta, right? People were vaxxed and masks were away, but Delta hadn't come yet. We were able to do an analyst day, which for us was great because we can take people through stores, have them feel product, that kind of thing. Everything else was done virtually. And look, I think there's some real pros to that, and there's a few cons. I mean, just selfishly, the fact that we were able to knock out 40 some odd meetings in 6 days, like sitting in, I think one person was sitting in this conference room. I was sitting in that conference room. So I was sitting in that conference room. We could stretch our legs for 15 minutes after a call and then not have to be in a black car and, rush into the airport and all of that. Like it probably helped our stamina and made us better in in telling the story. And it was great to be able to meet these people. So it's a super efficient way to generate billions of dollars of demand in your company. I also think in our case, we had a pretty clear story. We knew how we wanted to tell it. We'd refined it through the testing the waters. So we had it down, right? So the awkwardness of Zoom between our co-CEOs, myself, there really wasn't a lot of that because we knew what we wanted to say. So if you are going to do it virtually, really think about who's doing what part within your management team. What role is everybody playing? How do you want the flow of it to work? Get rid of some of that, potential awkwardness. Because I do think investors are not just reading the story, they're reading the team and they're reading you as individuals and you as a team and how cohesive that feels, and find a way to be able to convey that. The one other thing I would share is, now with these virtual roadshows, the virtual roadshow video has become this like big thing. So I was very much a CFO and very skeptical of how much the brand team was telling me it was going to cost us, the comms team to cost us to make one of these things, because it was basically a 30-minute commercial for Allbirds. I actually think it ended up making a huge difference, having a really high quality video for a brand company, certainly, right? A product company, to tell our story, to showcase our founders, to showcase the great things about the business, show the depth of the management team, the people who couldn't come to an analyst day. I do think it was ultimately kind of worth it. This whole process, that the numbers just get comical at a certain point to you, but like that was one where I was glad we spent a little bit more, because I actually think it made the process go a lot better, because people were able to watch the video and come in and meet us with a lot of context. And we didn't just have to lay all that ground. We could just touch on a couple things. So it was worth it in our case.
And you didn't have to spend the money on the actual roadshow part, on the travel.
Yeah, there are no jet fees or anything like that someone was gonna charge, for sure. So yeah.
Virtual roadshows are so much better. Sorry.
Yeah.
I was saying virtual roadshows are so much.
To get your perspective.
They're so much more efficient for management teams. You can meet more investors. You can meet them in places other than New York and Boston. And an old roadshow, you used to have like breakfast in Dallas and lunch in Denver, and then you'd do a meeting in Kansas City, and then you'd fly to LA to sleep and do a breakfast and then get on the plane. And it just it really wears on management. And to be able to do it virtually is, one, so much less wear and tear. Two, lets you meet so many more investors, lets you talk to the guy in Kansas City without having to fly for one meeting. I think they are the wave of the future. I think maybe there will be, if we ever get these viruses under control, I think, or this virus, whatever, I think maybe there'll be a big lunch in New York and a big lunch in Boston. But the real answer is start meeting investors sooner. Long before you're even in a process, you can do what's called an NDR, a non-deal roadshow, and ask a bank or two. Don't, again, put all your eggs in one basket. If they can introduce you to a couple of investors, and you can do early meetings, and they don't have to be perfectly put together. In fact, investors are kind of happy if they get to see you a little bit in the raw form. One, because they get a real sense of your business, and two, because they are also pretty smart people, and they can actually offer you some suggestions, many of which will be helpful because they will view your business from a different perspective than you do. And when you go to ultimately sell the stock, their perspective is pretty important. So meet investors early and often, do non-deal roadshows long before you hire official bankers. Then you'll do test the waters or TTW meetings when you have them. And if you do those, and these are all virtual, if you do a couple of virtual meetings, you don't have to, get on the plane and do breakfast in Atlanta and lunch in, I don't know, Dallas, whatever. So I think it is the wave of the future because it's just so much better to management, frankly.
And I'm sure like an academic has studied this, but like there's probably some ratio of like how much of a connection you make in person versus how many hours you have to spend to make that connection on Zoom. So this point of doing more meetings with people like in person, like, I mean, Jack, you and I spent a lot of time together on Zoom and phone calls, like over this process. We've never met in person, Jack and I, though we don't live all that far from each other. But I feel like when Jack sends me a text, like, Jack and I now have a relationship that built over time, where if we'd met for breakfast one morning, it probably would have happened a little bit faster. But it just speaks to Liz's point of, if you're going to be doing a lot of this virtually, put a little bit more time up front, have multiple meetings with people, and you'll get more comfortable and you'll get to know them better and vice versa. Because that's the con of it, right? There is something still to me about like personal connection, being able to walk in a room with people, read people's body language a little bit differently, the little jokes that kind of happen before or after the meetings, like those things you do lose out on the virtual roadshow. But we were happy to be able to sit in this office and knock out 6 days of meetings really efficiently.
Love it. Well, and I agree. It does sound like they're here to stay as we see, just companies starting to plan for Q1 deals. I think everybody's become accustomed to this method. And I think you both nailed it, that one, it's more efficient, but also on that buy side, right? For the people and the analysts that you're going to be meeting with. And also, look, there's a carbon footprint element to that, minimizing the travel. Bouncing all around. When we think of this number of deals, if everybody is now flying around the country for these, it does have a longer term effect. So we're gonna do key takeaways for both of you, and then also please for the audience, we have the Q&A chat in the bottom there. I've got a few questions. So we're going to do maybe a key takeaway or two that you'd love for the audience to hear, and then we'll jump into a few Q&A questions from the group, and then that'll conclude today. So Mike, I'll start with you on a few things that you learned through the process or you'd like to share with the next group going through this.
Yeah, I think it just really summarizes some of what we talked about. I think going back to your first principles, why do you want to go public? And really thinking that through and being clear about it. And then as part of that, as much as you can, try to pre-mortem things, right? Figure out like where the road trip could go sideways. Oh, there's always traffic in Bakersfield. Be aware of that kind of thing, right? So I think, and asking people outside, like what could possibly go wrong because you don't know, you haven't done it yet. I think part of that too is also like, there's a human psychology around the further you get into a deal and the closer you are to the finish line, the more you'll talk yourself into things. So one thing we did with our board of directors was we set out a very set, when we began the process, here's our go, no go criteria. Here it is across these 7 categories. And this is what we're aligning on like months before the IPO was ever going to happen, before we got to the first go, no go. Because as much as I try to be like objective in my seat in the organization as CFO, the reality is when I'm working, 18 hours a day, when I'm moving across country, when I'm doing all this, I'm invested, emotionally invested in wanting to make this happen. And even I know my like logical decision-making can't help but be clouded a little bit by just the process thing. So having some clear criteria ahead of time. And then the last thing is really, really, really focus on building your team ahead of time, growing your team during the process, checking in on people, giving people the room and the space kind of within your core team to raise concerns, ask silly questions, make sure they feel comfortable, make sure it all feels like one team. I kept talking about zone defense. I was like, no one person does an IPO, a group of people do an IPO together, and you have to create that really tight, really trusting sense across your whole team, because that group of people who are core to the transaction internally, they're going to make or break a big part of how great a transaction it is. So putting your energy not just into the models and the presentations and the meetings, but putting your energy as a leader into your team and making sure that team is performing really well and they can come to you, that's going to pay dividends over and over and over again in the process. And I'll tell you, now that we're through the transaction, like we've been through a battle. We made the road trip together, and now we know all the people's favorite song and the quirk here and that thing, and this person's kid always comes in at 6 p.m. because they need this on Zoom, right? We know all that, and we're much closer as a team now, and I think that makes us perform a lot better now as a public company.
And Liz?
Yeah, that is all great advice, and particularly, by the way, what are the make or break things? What are the go and no go? The more you can think about that in the very beginning, including what valuation. If the markets are crummy and the valuation is going to be X, we're not going. So much better to know that up front, because inertia is a powerful force. And once you get going, you'll tend to keep going and then think, why did we rush that? Advice number 1, it is your transaction. Figure out what parts of it are really important to you. And then don't take, no, it's not done that way as an answer from banks, because you can do all kinds of different things if they are, again, really structurally important to you. I wouldn't go crazy off the reservation, but what are the elements of the transaction? I worked on the Google IPO. They cared deeply that the individuals who tapped on those ads had access to the shares. That mattered a ton to them, and the entire structure of that transaction was designed so that individuals had the same playing field as institutions. That's just an example. So 1, what's important to you? It probably can be done. 2, don't hire logos, hire the people, the bank syndicate for you that really understands your business. And then can I say badass on this? Be tough about what prices, how much you're going to pay them, because they're excellent negotiators. And, if they want your deal enough, they'll come around as long as you're offering them something fair. And what would be number 3? I guess 3, again, just trying to be practical, is meet as many analysts as you can. And to the great point Mike made, the best way to figure out what analysts what analysts you want to meet are when you're meeting with the institutional investors and the bankers are out of the room, ask them who they listen to. That matters a ton. They're the audience for that research. Who do they like? So pick, as you put your team together, make sure it's your team and not the team somebody else put together that you looked at the precedents and said you should follow.
Well said. Well, I know this is being recorded and also streamed live, but hopefully everybody's taking notes because that was an incredible concluding wrap to the discussion for companies going through this or even thinking about going through it, right? Because we VCs talk, LPs talk, boards talk, CEOs, et cetera, right? Everybody's talking and thinking about, hey, is the window open and is now the time for us to go? And so this has been an incredible conversation, educating hopefully the audience, but even myself on best practices and things that teams need to be contemplating in going through this. So I guess we do have one question here from the audience. So this is, thank you, Scott. This is for you, Mike. How standard was your go or no-go list in categories? And could you share what they were just thematically?
Yeah, we split it up between, to Liz's point, market conditions broadly, what we thought that would mean for us kind of valuation wise. That's clearly a big part of it. We had COVID status, as one sort of like, a broader acts of God, but COVID status kind of like certainly was one. Then a lot of it for us, honestly, was like internal business performance. Did we feel like we had the momentum? Again, when we started to make the decision in the spring, vaccines were starting to roll out. There was a tremendous amount of optimism around the reopening. The reality is all birds perform well in, the heart of the pandemic, but we're definitely a bit more of a reopening play, right? People get back in offices, get back into life, needing a reason to wear something besides slippers and sweatpants, right? That's all good for us. As is the guy wearing a sweatshirt on this call, but it's an all-bird sweatshirt. But that the business performance, and not just top line, but what we're kind of doing on the middle of the P&L. And then within that, what we were asking ourselves were, what are we going to be telling people going forward? Not even the specific guidance, but what were the things that investors were going to buy into in the story? And did we feel like in the couple quarters before we were public, we were going to have the proof points to be able to show them? Like in our case, we've made significant, top line improvement, growing north of 30% the last 2 quarters. And we made huge improvement in our gross margins, so our unit economics continue to get better. Those are foundational to our story. So things like that are kind of unique to your business. And then the last thing then is sort of like the internal readiness. So making sure, like in our case, we were hiring an SEC reporting manager, we're hiring a SOX manager, like we got those roles filled, a securities lawyer. And then we also had a couple roles on the senior team, including the COO I referenced earlier, just making sure we had those roles filled because we knew we wanted to go out to the public markets with a full management team that we felt great about, that investors could trust to be good stewards to create shareholder value.
Great, thank you, Mike. And then there's one more here just around, Liz, I'll probably, this is for both of you, but I'll direct it to you first. What are the benefits of working with an outside IR consultant or firm, and is there a right time to leverage one, and then I guess compared to maybe an in-house IRO and that blend?
Yeah, so there's sort of 2 different categories, right? There's people you work with, like me, during the IPO process. We're not IR consultants. We don't do ongoing IR. There are ongoing IR firms. Look, if back from my days as an investor at T. Rowe, I always wanted to talk to somebody who sat in the office next to the CFO. If a company has the financial wherewithal to do it, bringing in an internal investor relations person is the way to go, because again, that's who your investors really want to talk to. And it takes some of the burden, a significant amount of the burden, off the shoulders of the CFO, who, does have some other stuff to do during the day. On the other hand, that's not efficient for every single company. And so some do hire quite a few hire third-party IR firms. Generally speaking, my view, and this is A, somewhat self-serving, but B, also accurate, is hire them later in the process. Their job is to, at some level, sell the story, but it's not necessarily helpful to have them early on in the room. And there's some regulatory issues that tell you that the people who are going to interact with the investors post-public are not the same people who can interact with you when you are structuring your transaction. So the short answer is, if you have the wherewithal, try to hire an internal IR person. If you don't, or just in the beginning, you just don't want to worry about it and you want to outsource it, great, hire IR, but get your confidential S1 filed first, then worry about hiring a third-party firm. Those folks are good at what they do, but they're working on a huge number of companies right now. They're not going to be focused. So bring them in and frankly start paying their monthly fee when you can get value for it. But short answer, if you can, internal IR is much preferred by the institutional investors.
Great. That is perfect. That is well said, and a perfect one to end on. We are right at time. So a sincere thank you, Mike and Liz, for joining us today. This was incredibly educational and helpful. And then a quick shout out for holiday gifts, Allbirds. Visit your store here in Palo Alto or around the world or .com. Most comfortable shoes I've ever had on my size 12. But
you're a good man, Jack.
Colin, we'll turn it over to you.
Jack's one of our biggest influencers. If you use the code Jack, no, I'm kidding. No, you can still get by ground shipping. Our supply chain is actually in really good shape right now. So in all seriousness, if you need some shoes, we love it. But thank you for having us, Jack. Liz, it was so great to meet you.
You too. You too. Jack, thank you. This was just terrific. Thank you for coordinating.
Thank you all for joining us. Thanks, Jack, Mike, and Liz. Really incredible insights on the executing the IPO process. If you're interested in booking a meeting with our partners, please use the link we just dropped in the chat box. Before we transition into our last session of the day, which is achieving success as a new public company, please take this time. We're going to take a little break, refill your coffee cups, take a quick break, and we will return shortly. So we'll see you back in 10. All right. Welcome back, everyone. Friendly reminder before we get started, we're going to open up for live Q&A at the end of this session. So please continue to submit those questions in the Q&A function at the bottom of your screen. Now, we hope the information provided by our experts so far is timely and valuable, and we look forward to staying in touch as your growth continues. So if you're interested in booking a meeting with our partners, please use the link provided in the chat. Now, without any further delay, please join me in giving a warm welcome to our special guests for this next panel on achieving success as a public company. Our moderator for this discussion is Janine, who's a partner at KPMG. So we're welcoming her back from her first session today. We also have Amanda, who's partner-elect at Wilson Sonsini. We have Priya, who's a partner and senior vice president at Woodruff Sawyer. And we have Jim, the CFO at Clearwater Analytics. Welcome, everyone. So happy to have you. And Janine, over to you.
Great. Thanks. Happy to be here. If you joined one of our earlier panels, you'll recognize me. My name is Janine Daly. I'm an audit partner with KPMG, and I have the pleasure of moderating our panel on achieving success as a new public company. So I'm going to start with letting our distinguished panelists introduce themselves, and I'll kick it over to you, Amanda, first.
Thank you, Janine, and thank you, Nasdaq, for having me. I am a partner-elect at Wilson Sonsini. I focus my practice on capital markets and public company representation, and I'm excited to speak to you today about achieving success as a new public company.
Great. Priya?
Thanks, Janine. Priya Huskins here. I'm a partner at Woodruff Sawyer, a full-service insurance brokerage. We're the unquestioned market leader when it comes to D&O insurance for IPOs, with a national market share that eclipses all others. I'm an expert when it comes to D&O insurance. I also serve on 3 public company boards, and I'm looking forward to this panel.
Thanks, Priya. And Jim?
Hi, Janine. It's great to see you. Hi, Priya. Great to see you again. Amanda, great to meet you. And for all the participants, I hope you're enjoying the session, and I hope it's productive for you all. I'm the CFO at Clearwater Analytics. We provide portfolio accounting and analytics software for investment accounting. And so if you're a corporation or an insurance company or an asset manager, you could be a client of ours. So look forward to speaking to all of you. And we recently went public in September of this year. So thanks. And Janine is our audit partner. So
yeah. All right. Okay. So let's kick it off. A big piece of achieving success post IPO is having the right team in place. And we heard in earlier panels about the importance of team dynamics, both internally and externally. And I know for all industries, there's a war for talent right now. So it can be hard to get the right people in place. Jim, you went public in September. with the current competition for talent, what strategies did the company employ to recruit and retain employees?
Yeah, thanks. We definitely experience, the battle for talent. And one of the great things that an IPO provides for a company is it really opens up the visibility for all of your employees, and it really enables a lot more access to a lot of employees to equity compensation. So what I would say is as you contemplate an IPO process and as you think it through, really spend, the adequate time to really contemplate how it's going to impact each of your employees and what are the programs that you can put in place. We had a separate work stream where we kind of sat down with a compensation consultant, and our chief human resource officer and I and our chief legal officer really spend a significant amount of time. It's a very busy time as you're kind of going through the IPO process, but this is something that, really becomes important. And I think it comes down to also having an initial conversation with your board and with your CEO to say, okay, is this a priority? Is this something that we're going to really focus on? And once you get that tone to try and understand that, then there's a whole variety of programs that you can implement. For example, we implemented a directed share program for all of our employees that enables your employees to basically allocates a portion of your IPO to these folks and can be employees, and that allows them to buy at that IPO price. The second thing I think you think about, and Amanda, I'm sure you have conversations with it with your clients as well as with the underwriters, is what's the lockup period? Who's I think the lockup period is pretty fixed, but who is under that lockup and how does that work? And what are the things you can do for your employees around that? The third thing that we were really focused on was globally allowing our employees to participate in the employee stock purchase program. So that DSP program allows employees to buy right at that first moment, but an ESPP program allows them to buy kind of at a discounted rate, the stock over an extended period of time. And for us to be able to roll that out, there's real tax benefits to it in the US, but to roll it out globally, really promotes fairness there. And then you have all variety of equity award choices to make with folks. Do you do options? So historically, we had done options. We had about 1,200 employees at the company at the time we went public, but not all of them had options historically, maybe 25% of them. This enabled us, going public enabled everybody to participate in it. And so we actually chose to give everyone RSUs that vest kind of over time so that everyone has a place in that. And so through those three programs, we were able to broadly distribute it to all of our employees. The benefit for those folks who already had, the 25% of the folks who already had options, was they could finally crystallize that, options are pretty complicated. And so what's it worth? How's the value work? Well, there's suddenly this crystallization of what that value is. And so, that can be a real morale building and kind of team building focus. So and I guess the last piece I would say is then some of those historical options. Sometimes when you're a private company, you have certain objectives there that could be different when those objectives flow through into a public environment. And so cleaning up all those options, doing that IPO at that point in time is maybe it's better to do it a little in advance, but definitely do it at the time of the IPO. And that seems to work. Sorry,
Yeah.
That was kind of long-winded, sorry.
No, that's great. That was great. And I know earlier we were talking about the different sort of equity plans and how to think through that. And I know you guys were particularly focused on making sure all of your employees felt invested in the process, which I think does help from a retention standpoint, right? Because they want to see it through, right? Not just the IPO, but the long-term potential, after the IPO. So that's great. And, Priya, you talked about your board experience. I think talent certainly extends to the board level, and it's really important to attract those right board members. And, sometimes the board that got you to the point where you went public is not really the board that's the right set of individuals to sort of oversee the company at the next stage. So what sort of tips would you give to this group when they're thinking about a board refreshment in that post-IPO world?
So sometimes it's very easy to understand what you no longer need. And I am looking at you, guy who's on the board because you're somebody's brother-in-law or uncle. That's super awkward, right? And maybe we're great, just super advisors at one point, but maybe not appropriate for the next time of the company. And so what I would say in that regard is actually having a good nom gov chair or somebody that you're recruiting into that role can be very helpful. Board succession is literally one of the hardest things that corporations do at the board level. And going in early with an understanding that things are going to change and expressing that to the current board may be quite important. Your venture capital board members are generally pretty ready to get off the board. That's not usually the issue. And all of this is aided by knowing where are we going, right? We don't want to flee from things. We want to run deliberately towards something useful. And in that regard, your post-IPO board, that's part of your brand as a company. And simultaneously, you're looking for folks who genuinely want to help management, the CEO, grow the company, scale the company. And so what I think about for a new public company board is what is the team that you're going to feel to support the growth of the company, the growth of experience and operations, everything else for the management team and others. And so look for folks first who have scaled a company recently. And I do emphasize recently, today's challenges are not the challenges of 10 years ago. If your person who's super good at scaling also is tied to the only way a good company can grow is by having everybody sitting at corporate headquarters, you know you've missed something there, right? Things are different today. But I'm also going to say the opposite. In addition to people with recent experience, you want one or two that's the opposite, that have had a very long career, that have seen a lot of business cycles and can have some wisdom about what they learned from those cycles that they can bring to the board. And then the third element I would just mention in this moment is actually corporate governance. And in this regard, business-minded lawyers can actually be quite good. They are often the ones who know the rules, but have the experience that can actually help a young company not overlay too much corporate governance bureaucracy, not have too stiff an infrastructure that will cut down on flexibility, but just enough so that the company can grow appropriately. Janine, it's also obviously very hard to attract all these right people in the time frame of doing an IPO. And so as we're recruiting, think about actually using an external recruiter that tends to help and being prepared to talk about why your company is right for this new set of directors. And finally, how are you going to protect them? IPOs, new public company, it's high stakes, high risk for independent directors. So things like personal indemnification agreements and my personal favorite topic, D&O insurance, are both very important when it comes to recruiting independent directors.
Yeah, that's great. You know, we did hear earlier that especially given the volume of transactions that are going on right now, you should be thinking about this board recruitment process, 12 months plus, prior to operating as a public company. So I think that's great advice. And Amanda, it's a good tie-in to you from a corporate governance perspective, because obviously risk management, right, when you're going through the recruiting, hiring, and retaining of both employees and board members in those first few years as a public company requires sort of special attention. So what advice would you give from that perspective?
Sure. First, I would say that many of our clients are experiencing unprecedented recruiting competition and retention pressures at all levels within their organizations for directors, members of management, employees. So just to echo what Jim and Priya have said, from a legal compliance perspective, companies should be aware of existing and forthcoming requirements related to their board and workforce composition. So these could impact recruitment and retention efforts. And one area I want to dial in on is diversity. The SEC's current rulemaking agenda includes corporate board diversity. And as you know, Nasdaq has a new board diversity rule, and a handful of states have rules or proposed rules related to board or workforce diversity. And some of these rules have phase-in periods or are tied to a company's board size. So it's really important to consult with your outside counsel to fully understand the applicability of these rules as you're recruiting and retaining directors. From a practical perspective, it may be helpful, as Jim had mentioned, to think about what other companies are doing to stay competitive. As he mentioned, with lockup agreements for companies that are just going public, what we are increasingly seeing is the use of early lockup releases to give employees liquidity on their already vested equity. Those are a lot to think about and can be quite complicated. So if you're thinking about using an early lockup release, start planning early, make sure you involve your outside counsel in those discussions, and there are several important securities laws considerations. More broadly, what we're seeing in terms of some existing trends in executive compensation or employment compensation are more companies are offering equity vesting without a cliff or offering larger equity grants, often in the 75th percentile range. We're seeing sign-on bonuses and cash or equity to bridge value gaps from what is being offered from current employers. We're seeing a lot of activity in the perk space, company paid housing, commuting costs, elimination of requirements to relocate, paid apartments, flights, things like this. Many companies are also increasing their focus on workforce culture by offering increased flexibility, additional paid time off during the pandemic, stipends for health and wellness, programs and resources that support well-being or work-life balance, making increased commitments to diversity. One cautionary note on all of this is we've seen quite a bit of plaintiff side activity. Plaintiffs are filing several lawsuits alleging that companies have failed to meet their stated diversity commitments. Not a reason not to make commitments, but it is a reminder that companies need to follow through on what they say, or be sure not to overstate their actual commitments at the outset, which can be really important in this, very competitive climate.
Yeah, that's interesting. And that is a good reminder, because I think there's, and we heard this in the market remarks, there are companies that are going public, right, that are focusing on disclosures around diversity or environmental sort of factors and want to put that in their document. So the execution right on the other side of the IPO is as important as all the stuff, right, for lack of a better word, that is going into the document at that point in time. So it's interesting. I think that's a good segue into sort of switching focuses from internal sort of employees in the board to external. And one of the things that we hear a lot about right now is ESG and diversity and some of the transparency around that. And I think there's certainly more pressure from both users of the financial statements as well as regulators to have that increased transparency in what public companies are disclosing. So Priya, as a new public company, what should they be thinking about when it comes to ESG initiatives, and when is the right time, right, to start approaching that topic?
Yeah. This is actually a tough one. So let me just start. So by a little table setting, ESG is, of course, a reference to three things that don't actually really belong together in a natural way, but we're just saying it together now. So environment, social, governance. In a lot of ways, governance is actually the easiest for a new public company, because in its simplest form, truly, do what your law firm tells you to do. Don't fight it. If Amanda says do XYZ corporate governance, don't fuss, don't try to innovate. Seriously, just do it. And indeed, you can often get credit for some of that with when it comes to D&O insurance. Corporate governance is the fire sprinklers of D&O risk. So don't fight it, just do it. Governance is also relevant for the S and the E. And in that regard, I'd ask you to consider two principles: authenticity and sustainability. And I'm going to explain that in just a second. Let me get to the E. So E, environment. That's not easy, but it is increasingly defined. There are lots of standards and frameworks out there. And for a company that is about to go public, thinking about going public, or just has gone public, I'd point out two things. One, whatever you choose to talk about it accurately. The big foot fault here is aspirational disclosure, which is not the same as accurate disclosure. And the other thing is the sustainability part. In this regard, I mean, only talk about things that you're willing to keep discussing. So the common foot fault here is out of an abundance of sincere enthusiasm, kind of going too far. That won't serve you. So it's okay to be a little bit pulled back. You do not need to be on the bleeding edge of this kind of disclosure your first few years out of the gate. And the other thing is, if you blow it on either the authenticity, accuracy, or sustainability, social media will punish you, as will perhaps legal liability. So hopefully that's a good incentive to kind of cabin what you're planning to do. You will need to do a sustainability report if you plan to be public for any amount of time. So start lining up your consultants in that regard. And then the S, social. So social in ESG, in my view, is human capital management plus social justice. So D, E, and I, diversity, equity, and inclusion, it's just table stakes at this point. You're going to want to rely on your HR professionals to help you pull up programs that are going to make sense and, again, are authentic to the culture of your company. What I actually think is harder is making a decision. Are you, as a new public company, going to be taking positions on current social issues? That can be especially easy for a young company to do, and it can be infinitely distracting. At the same time, you will have employees that increasingly demand that your corporation be part of the existing, the current social issues of the day. And so this is tough. It's also a place where it is fabulous to have seasoned, wise public company directors that can, again, help provide a steady base of advice as you, as a new public company, are navigating what is your posture for these kinds of issues. And then sort of last thing, when do you start? So if you haven't started yet, start now. And I don't actually care what part of the journey you are in. I would also observe that anybody who showed up at this webinar, you're probably planners. And so just having a cadence, not making this more than it needs to be, but just and understanding that by the time you are a public company, you need some infrastructure in place to support ESG.
Yeah, and that's becoming, I think, even more important as we see movement on the regulatory front, right, to actually mandate disclosure on some of these topics. And so, Amanda, the SEC introduced the human capital disclosure requirements for public companies late last year, I think around August. And then they have climate change disclosure and human capital management disclosure on their current rulemaking agenda. So how are companies ramping up and preparing for having to disclose those requirements in their documents?
Absolutely. So, as you, Janine, and Priya have mentioned, institutional investors and regulators have made clear that ESG is an important area of focus. So I think we can safely say that it's here to stay for the near future. Quickly on the institutional investor side, institutional investors are increasingly covering ESG, including climate change and diversity and inclusion, in their voting guidelines, and are raising these issues consistently during companies' shareholder outreach efforts. So companies should, be prepared to talk about ESG and all elements of it at the outset. On the regulatory side, SEC has demonstrated an agency-wide heightened focus in the last year and a half. The SEC's new disclosure requirements on human capital management, as Janine mentioned, went into effect in late 2020, and most companies first reflected these in their 2021 10Ks. And the new rules required companies to disclose their human capital resources, measures, and objectives to the extent they were material to their business. And we saw a wide range of disclosure across companies and industries. We are expecting additional SEC rulemaking in this area as part of the SEC's rulemaking agenda, as Janine mentioned. And some of the commissioners, including the chair, have indicated a potential introduction of new quantitative metrics related to human capital management. So stay posted on those. The SEC's current rulemaking agenda also includes disclosure related to climate risk. We don't yet know what those rules will entail. The good news for newly public companies is that the SEC rules are likely to be effective in 2023. So you have a bit of time to, inform yourselves about the new rules that are forthcoming, and then determine what you're going to say publicly. Just a few points on the SEC's kind of broad approach this year, specifically on climate. The Division of Corporation Finance said that it was enhancing its focus on climate-related disclosures based on the Commission's 2010 guidance, which has basically a materiality standard, and has issued several comment letters on climate-related disclosures. And in September of this year, the SEC issued a sample comment letter to inform issuers on the types of comments that it would be issuing on the climate side. So if you haven't taken a look at that, it's a good idea to take a look. The Division of Examination announced that climate-related risks would be an examination priority, and the Division of Enforcement formed a 22-person task force that will be focused on identifying material gaps or misstatements in companies' disclosure of climate risks. So that's a particular reminder to make sure that anything that you disclose in your public filings, in sustainability, CSR reports, on your website, that you're consistent with your messaging, and that you're disclosing all material items in your SEC reporting. A couple of things, just pointers that newly public companies can begin to consider as we wait for the new rules and the effective date of them. I think newly public companies can begin to think about clarifying their board and committee oversight over ESG. So let me pause on that for one moment. Often institutional investors are eager to understand how boards are organizing themselves in their oversight of a company's ESG risks and impacts. So is ESG overseen by the entire board, by one of the established board committees? Is there a bespoke ESG committee? Do you have some other oversight methodology? And increasingly, companies are disclosing their oversight in their public reports. So that's one thing for newly public companies to begin to think about. My personal opinion is when you're newly public, it's often helpful to have that oversight at the whole board level until you sort of figure out how oversight is best allocated to committees. Some of our more mature public companies, bifurcate or have oversight in different areas. So if they have, financial reporting that goes to ESG factors, the audit committee may oversee that. Or if achievement of certain objectives is tied to compensation, the compensation committee might oversee a part of that. But for newly public companies, you probably don't have that level of detail with your ESG reporting or oversight. A couple other things to consider: developing internal processes for evaluating ESG risks and impacts and collecting the relevant information to make those assessments. Again, knowing what your institutional investors' positions and perspectives are, so you know what you're going to be up against with your investors. The investors' voting guidelines or policies typically come out in March, January through March each year. So keep those close in hand and keep your eyes peeled for those for this coming reporting season. It's also really helpful to benchmark against peer disclosures. This can be particularly helpful this year for human capital management because there was such a wide range of disclosure that we saw last year. So getting a sense of what other companies in your industry or your peer companies are doing can be helpful in figuring out sort of where you want to land this year. One point on benchmarking: don't necessarily get trapped in looking at just your peers. I like to encourage my clients to look at some companies of similar maturity outside of their space, look at some companies within their space that are, 5-10 years ahead of them, to get some sense of the aspirational disclosure practice and get some diversity in the, resources that they're looking at.
It's good advice. It's a lot to take in, but it makes sense because it's, as Priya said, we've got basically 3 distinct topics that we're all trying to cover down on. And I think, Jim, it would be interesting to hear your perspective, right? You just went through the roadshow. You're talking to lots of people all the time, right? Institutional investors, you're talking now probably to some analysts, different stakeholders. Anything on these topics where you were surprised in terms of questions asked, or wish you had better vetted certain things going into the process?
Sure. I think the most important thing for, ESG topics are really important to investors. They're also, half of our employee base are millennials. So it's really important to our employee base, in particular. It's important to me, but it's more important to the millennial. I mean, it is equally as important to our millennial employees are more passionate as well. And it's very important to all of us. And so that passion has grown. And it's really important to our clients and our prospects, right? And so when you think about the story that you're explaining to investors, to your employees, to your clients about ESG, or honestly about any topic, you have to have those concentric circles that are overlapping. There are portions of each of these topics and any topic that are more, the constituency is more focused on, but in some, the story has to fit together, right? To be authentic. You hit the nail on the head. It's about that authenticity. And so then when you think about the one thing in speaking with investors so much that I continually have to remind myself of is that, never underestimate how many times you kind of have to tell them the same thing. You have to repeat that story over and over again. And it feels, it can sometimes feel a little like I sometimes am reluctant to do it because it feels a little pejorative. But I think that you have to also understand they're talking to 1,000 companies. Investors are talking to 1,000 companies. Clients have hundreds of vendors, right? And so to go back to those same principles and to focus back on that and say that time and again, kind of almost repeating yourself to make sure that people are kind of understanding that story was kind of the one thing that I had forgotten, and now I remember so much that it's that's a really, really important. I'd say the other thing that as a public company CFO that surprised me a little bit is investors are also asking you about other public companies as well. And so if, there are certain ones that you're competing against and certain ones that are in your peer group, but there's also other ones that kind of, because investors probably have a much broader aperture and you're really focused on really executing in your business. So you have to be pretty prepared for people to come at it from kind of this orthogonal angle. And this is where some of these topics come up. And so I think it's useful to really have that broad perspective and kind of trying to understand that.
Yeah, and that's a good reminder too, that the folks that are interested in these topics are all your stakeholders, including your customers, right? And the transparency at that level and consistency amongst the communication in that circle, right, is really important. So I'd like to pivot a bit because we get a lot of questions around, gosh, you're public, thinking back on the past year or thinking forward, what are some do's and don'ts, or things that you wish you knew, right, that you would have done differently if you were going through the process again. I think that's a really interesting topic for folks to hear about. So Amanda, I'd like to start with you from sort of the corporate lawyer perspective, right? You're involved with companies on the whole journey, pre and post IPO. So any sort of practical suggestions on what to do and not to do in this new space as a public company?
Absolutely. So I'll give you 4. The first I would say is to keep it cross-functional. So many of the processes that public companies navigate, periodic reporting, earnings, they require input from distinct functions within the organization and teams that may not be used to sharing information or working together in the ways that will be required. So try to keep trainings, meetings, decision-making cross-functional. It not only helps efficiency, but also can help reduce risk. A quick example, I have a newly public company client that was doing our first M&A deal, as a public company, and the legal team and corp dev team were taking the lead and getting the term sheet locked in, and then passed it on to the finance and FP&A teams. And it turns out there are all sorts of accounting implications to issuances of different types of equity that were being considered in the deal. And so it was really important to have those, it would have been really helpful to have those in the term sheet phase to consider the accounting implications. So this is a principle I think that companies, can really, really, really utilize and leverage, just always thinking cross-functionally. And I think that once you build a bit of muscle memory on it, when you start being cross-functional over and over, individuals start thinking, well, I should probably check with this person, or let me run this or bounce this idea off of someone out of some, another department. And so I think being cross-functional is the first thing I would recommend. The second is one that is my personal favorite, and I also recommend this for our law firm culture, is cultivating a no blame culture. So newly public companies are going to make mistakes, despite best intentions. Everyone makes mistakes. With the advice and consultation of your advisors, you're definitely going to find solutions. Companies that have a culture of blame are less likely to surface issues early and to evoke an all hands on deck approach when solutions are identified. So I've seen across our client base various cultural approaches, and I really think that teams that have a no blame culture seem to truly excel. The third would be to take initiative in understanding the best and highest use of your advisors. So remember, it's okay to get an outside perspective, involve a third party. You have access to very sophisticated advisors who, you can turn to for different types of support. For example, many newly public companies stumble a bit out of the gate on investor relations. It may be more helpful to talk to an investor relations firm instead of your outside legal counsel if you know very well and is very sophisticated. Know the full range of your advisors available to you and know how to utilize them for the things that they do best. And don't be afraid to ask your external advisors, what resources they can offer you. Your advisors have a lot of resources and access to information and people across their client base. So do they sponsor events that you can attend to build your knowledge base, or can they make introductions on your behalf? The last would be invest in employee education. Do your employees understand the insider trading policy? Do they know what types of information qualify as material non-public information? Do they understand blackout periods? Do they know, when your company's blackout period is and how they would figure that out? Do they know what the company's external communications policy is, and when and how they can speak on behalf of the company? I spent a bit of time in-house, which has really informed my perspective as an attorney at my firm, because I really do think that employee education, at the outset for a newly public company that has all of these new policies and requirements, can be really, really helpful, especially in lowering risk, because your employees unfortunately will be oftentimes your vectors for risk.
Yeah, I love that, because we heard earlier today from Jesse, a CFO at the Revolve Group, that employee education, right, was a critical aspect of even the onboarding through the IPO process, and dedicating energy. And it takes more than you think to kind of get everyone on the same page and sort of moving forward collectively. Jim, in your CFO role, you're going through your first 10K, right? And then, which, I'm going to go through with you, so that's great. Right. And then, you have your—
We got great advisors, right?
That's right. Yeah. So you have your goals for, this first year, and then moving forward, what really are you focused on overall to drive success in this post-IPO first year?
Yeah, I think it's, to drive success, really we have to just follow through on, kind of all of the great opportunity that's ahead for us that we have kind of articulated to investors. But it really comes down to, and frankly, not only articulated to investors, but kind of over our past kind of driven through that. So it's a little bit of, I totally agree with you, Amanda, that, we have to focus on things cross-functionally, and we focus on kind of employee education and driving that. And I think by doing that and setting the frameworks in place, what that enables is to then limit the distraction. You have to understand, okay, what do you have to worry about and what don't you have to worry about for everyone? Because it's, to see the stock price move every single day can get people, like, people are people. They look at that, they think about those things. And so we really have to go back to these first principles, which is like, we have this huge TAM, we have a displacement quality product, we have an opportunity in the marketplace to really be a special company, but you have to, build great solutions, you have to delight your clients and continue to add those, and you have to recruit, retain, and motivate kind of all of those employees. And the truth is, we're a whole team and we all have our little pieces to do on that. And we have to, there's a part of it, but we also have to step back and say, okay, we're going to focus on this, but we're not going to let it kind of overwhelm, because the overheads of being a public company, let's just be real, they are large, whether it be your D&O, your external advisors, right? And all of the time you're spending communicating with your new board structure, with your new investors. There's a layer there. And so it's important to acknowledge that, give people each a role in all of that piece. But really, at the end of the day, IR is incredibly easy when you make your numbers, when you're winning in the marketplace, when you're making people successful, then kind of the numbers take care of themselves, and that sort of works out. So that's kind of we'll see. You're right, Janine. It's still early days, and there's a lot of work to do. But that's kind of, I think that would be success if we're able to really deliver on the opportunity that's available for.
Mm-hmm. Yeah, and there's so much noise as you're going through the process. Like you said, Jim, there's just a lot of distractions in it. And it feels like the actual process of, filing that registration statement, having it being declared effective it should be like the end point, but it's really the starting point, right? It's the starting point of everything else that you need to do. And going back to the basics on execution, right, of like your core principles, sometimes that could be a hard pivot from all the stuff you were doing leading up to that point. Priya, from a risk management perspective, there's probably a lot to think about in that first year, but what are some of the traps that you see people kind of get caught up in, and really how to avoid those traps?
Yeah. So the statistics concerning just litigation against new public companies are terrible. And that's the thing we want to avoid, right? I mean, that's pretty straightforward. And first and foremost, and I think this is just going to sound like I'm also in favorhood of motherhood and American pie, but invest in your culture. And I specifically mean be explicit about your company's view on growth versus integrity, or on salesmanship versus we're just full out lying about our product. Those things will come back to bite you. And it's frankly usually not the C-suite that's first in line in making those errors, but maybe in the name of accountability or growth, they've actually failed to be super clear that we care first about integrity. We want our disclosures to be accurate. It matters what we're saying to our customers. Don't try and make it up next quarter. That ends badly. So invest in your culture. And boy, Jim said it so well. When things are going well, it's really fun and easy. But the question is, are your small problems going to be addressed timely? Are you going to take that little hit? Or are we going to wait till it's a bigger problem? And bigger problems don't smell better than the small problems. So I encourage everyone who is so excited about the IPO process to remember this part about culture. Second thing, from a risk management perspective, is to invest in a sustainable infrastructure, or just misery and sorrow will follow. You actually do need enough people in finance. You actually do need enough people in legal. And I get it. It feels like overhead, because it is. And yet, if you don't invest timely in those things, you will fail. The analogy that I use, which we're going to find out if anybody else thinks it's funny besides me in just a second, is I remember when one of my son's feet were as big as mine are, but he was, of course, not as tall as I am. And I said to my husband, I think that's so weird. And he responded by saying, well, if it were the reverse, he'd fall over, right? Yeah, that's a good point. But that's such a good analogy, right? If your infrastructure is too big and flopping around out there, you're going to fall over. But the same is true if it's too small. You're just going to fall right over. So think about that. And then my last thing, Jim and Amanda both spoke to, they called it cross-functional. The way I think of it is taking a holistic approach to risk versus tragic separate silos. And in this regard, the role of the GC and a CFO as accountability partners to each other and as bridges across the organization can be very helpful. Hopefully it's not just those two, but it's a broader circle of the C-suite that works together very well. Think in terms of setting up subcommittees where it's not necessarily the C-suite people, but the people 1 or 2 levels below, which creates also internal succession opportunities, training. It can be really wonderful. And just on this one point, be explicit about who's handling insurance. You want to be ready for public company scrutiny across all of your insurance before you go public. Right now, a lot of general counsels actually lead that with strong input from finance. What matters is that we all agreed ahead of time so that you're not fixing things as this plane is now in flight.
Yeah, that's great advice. And I love the analogy. I'm thinking of my sons who are 4 and 1, so I can't even imagine that. But I think, let's see, yeah, we probably need to pivot to Q&A. But before we do that, I would love to just hear, is there, one takeaway that you would love to leave this group with before we start some Q&A? So maybe Amanda, starting with you.
Sure. I think the one takeaway that I would want to leave you with is that even though, when you're a newly public company, the landscape is vast and there are a bunch of new requirements, don't allow, and Priya, you will have to chime in on this one too, but don't allow risk to become overly burdensome, because as a lawyer, I know I'm often speaking about risk, but you can, with the advice and consultation of your advisors, find a pathway to balance risk and navigate risk against your business priorities. And your advisors, if they're business minded, will work with you hand in hand to find the how, instead of it being yes or no.
Yeah, that's great. Jim, what about you?
Sure. I'd say, stepping through the IPO process is, it's very exciting. It's very fulsome. There's lots of steps. It's a lot of work, and it's a great accomplishment and very exciting moment in time. It is also just the beginning, and so I think as you begin that process to then live in that new world, I think it's really important for you as a team to come together as a management team and with your execs and your board to think through why is being public really important for the company, right? Does it give us a branding opportunity? Does it help with our employees? Does it help with kind of our new clients? Does it allow us to take on more strategies? And if you have an honest conversation about that to begin with, then when you're in those long hours where you're working through this and you're kind of figuring out all these new requirements step by step, you understand, oh, this is the benefit of it in the end.
That's great. Yeah. And Priya?
So what I'd say is it's okay to say, I don't want to deal with the infrastructure of being a public company. I've looked into my soul, and what I've realized is I can't balance growth and risk. I'm going to be totally distracted. It's going to be awful, and I'll be miserable, as will my whole family. And if that is your conclusion, you go be an M&A target. It's fine. Now, to be an M&A target, you're going to need a little infrastructure so that you can be appropriately rolled into the public company that buys you. But that's okay. On the other hand, if you want to be a public company and serving as I do on boards, I think it's great. Obviously, everybody else on this call thinks public companies are great. But if you want to do that, then embrace what you need to do in terms of infrastructure, really lean into it and make it work for you. What doesn't work is some kind of cringy, reluctant relationship with public company infrastructure. It's painful, it will be done poorly, and ultimately it will underserve you. So my key takeaway is good for you for being informed by coming to sessions like this. Make a choice and execute accordingly.
And maybe then I think that's a good segue into Q&A. And I'd love to start with you, Priya, because you touched upon M&A and we've talked about IPOs. There's been obviously a lot of SPAC activity, right? And people, are thinking about that pathway since it's got a little bit more visibility this year and the de-SPACing process. So when you think about that and the risks, is there anything that you would, touch upon from a consideration perspective if folks are looking at potentially being a SPAC acquisition target?
So I love this question. And part of why I love it is I think my answer has changed every single month from 2019 onward. And that very much, right, tracks what's been going on in SPAC world. So anybody who tried to do a de-SPAC transaction to go public because they thought it was faster, easier, and less expensive have all learned that that turns out not to be true at all. So that's a bummer, right? And I think that inevitably there's been a lot of very negative press about de-SPACing. And I'm kind of find that very interesting because the press that focuses on negative aspects of de-SPACing seems to forget that a lot of IPO companies in the past were super not ready. And let's be honest, that kind of persists today. So in some sense, there is a very unfair comparison going on between the IPO path and the de-SPAC path. And part of it is the entire capital markets ecosystem is figuring out what is an appropriate way to do a de-SPAC transaction. And I'm going to include our friends at the SEC in the category of people who are on a journey of discovery. So being more specific, my recommendation is it's as always, it's a multi-step process. It's first understanding, is your company ready for public company scrutiny? If the answer is no, stop meeting with bankers and figure that out, right? After that, then the question of, are we going to do an IPO? Are we going to do a de-SPAC transaction? In some sense, it's opportunistic, it's valuation driven, it's all of those other soft factors, but what it is not is necessarily faster, easier, or cheaper. Like, we're not kidding ourselves about that. I do think the best thing about the whole de-SPACing phenomenon is it is fabulous for capital markets that we have a new way to go public, right? I mean, direct listings, we've seen some, they're not a ton. These other innovations have been interesting, but when was the last time you had a totally new way to go public that people were doing? That is a good thing for our financial system. So clearly I'm into it, but just know what you're getting into.
Yeah, that's great advice, and totally agree on there's no expedited prices under the SPAC umbrella. That's for sure. Jim, I wanted to touch on something you said earlier and tie into some of our Q&A. So you had talked about the overhead of being a public company, and I hear a lot of folks asking, okay, well, what is the administrative burden of being a public company, right? Like, how much incremental time and effort is introduced into the process because you're now public to sort of think about preparing for headcount from that perspective. What's your views there?
Yeah, I think it obviously it varies a lot depending on kind of the size of the underlying company and how that all kind of fits together in your market cap. But I think if you just start with just executive time, right? There's probably 10 to 15% of executive time is and that's not just the CFO's time, that's the executive leadership team's time that's going to be spent incrementally, either through additional board meetings or through meeting with investors. Then you step through and you say, as Priya talked about, you've got a whole legal team that's buttressed there. You have a whole financial accounting and reporting and the controls and compliance and all of those elements to it. So as we went through the process and we started talking about this about 18 months ago, I made a list, and we don't have a huge team here, but I said there are 5 key individuals that we need to hire before we start on this journey even. So we needed to kind of step through the door and say, okay, even if we wanted to go through this process, there's these kind of 5 key roles that you wouldn't typically have as a private company. And then we stepped through, got those, and then moved forward from that. So in addition, you have kind of your outside vendor costs, which just go up. And so I would say when you add all that up, we've looked at kind of the costs of G&A costs, pre and post, and it's up about 20 to 30%.
That's
not
good.
our total costs, just our
yeah,
G&A.
yeah. And that's what I've heard too. Working with lots of companies through this process, that is a common benchmark. I think one of the other questions that we've gotten, and it gets a lot of attention from the SEC, is non-GAAP metrics and KPI metrics. And in an earlier panel, I had mentioned the SEC is still super focused on non-GAAP, right? Like, what's being disclosed, how prominent is it? Are you reconciling it to all the right things? Why are you disclosing it, right? And so as companies are thinking about that, what non-GAAP metrics are relevant in the post-IPO world and how they should be disclosing that, what should they be thinking about to stay, I guess, within the railways of what the SEC deems acceptable? And maybe, Amanda, that's a good question for you.
Sure. So with non-GAAP financial measures, there are some fairly technical rules that you have to follow. So I would advise companies always, when they're putting out non-GAAP financial measures in investor presentations, earnings releases, any public filings, any public forum, to consult your outside counsel, because the rules are different for earnings releases on a Form 8K, and if you do as compared to an investor presentation. So you'll want to make sure you follow the letter of the law. As sort of a general principle underlying non-GAAP financial measures, the real focus of the SEC in the last few years has been on misleading investors. So I think the motivating force behind including reconciliations, of non-GAAP financial measures to the most comparable GAAP measure is really to give investors, transparency around all of these different metrics that you're using, because different issuers calculate non-GAAP financial measures in different ways. So it's very difficult from an investor perspective to understand, if you see, a non-GAAP metric by one, put forth by one company and the same metric by another you might be inclined to compare them, but they may be calculated differently. So I think the real focus behind them is ensuring that you're not misleading investors and you're giving them full information to really understand who you've arrived at this non-GAAP or unusual metric, so that they can benchmark and compare when they make investment decisions. I think that's what I'd say generally about the spirit of the rules, but they are quite technical. So make sure that you talk to your counsel before putting them out there. And we have seen a lot of companies get into trouble with the SEC and plaintiff side firms that will go after companies if they don't have proper disclosure in their proxies or things like that.
Mm-hmm. Yeah, that's good advice. I think we have time for one more question, and Priya, I'd like to end with you, just leveraging off of what Jim said a minute ago about incremental costs, because we also heard earlier from Mike that the cost of D&O insurance can be quite high for newly public companies. So some folks may be wondering, okay, fine, I get it, but when does that cost go down? And is there anything that we can do as a company to expedite that?
Well, I appreciate the question, and I absolutely recognize that the cost of D&O insurance is just flooring. And an interesting thing to me is that the thing that helped D&O insurance underwriters embrace IPOs in a more sustainable way is de-SPAC transactions. De-SPAC transactions for insurance, the insurance community have made doing an IPO seem like a very conservative, boring thing to do, and that's good in insurance. The answer to your question, one of the reasons insurance is so expensive, of course, is because of that strict liability for the registration statement. And remember that if you did a registration statement for your IPO and then you did a follow-on offering shortly thereafter, every registration statement has 3 years of strict liability. But we generally think to ourselves, all right, 3 years out, we are past the statute of limitations for the original IPO document. And so that improves a company's risk profile. Fun fact, I have had clients sued a month before that 3-year statute of limitations run, so that's real. But here's the thing, 3 years after your IPO, I hope you're a bigger company, right? That was the plan. Usually that's the plan. I've never seen an IPO prospectus saying our plan is to be the same, if not possibly shrink. And what I'm saying about that is the bigger the company, the bigger the potential exposure if there's a big stock drop. So it can be difficult to see for a new public company as they exit their 3rd year, the hope that suddenly their price will drop precipitously tends to not be there for lots of reasons, including the fact that they're just bigger. The other thing to just know is pricing for D&O insurance is as much about macro factors as it is about your company itself very often. So it is worth controlling what you can control. The big one on that is corporate governance. I said it earlier, they're the fire sprinklers of risk. To the extent that you don't actually have precipitous stock drops, you may not be able to help that. But claims coming out of it because you have challenge disclosure, something you can have more control over, that's a very big deal. The other thing I'd say is don't overbuy your insurance. So if a company doubles in size, you don't need twice as much D&O insurance. And so my recommendation on that is it's fine to look at what your peers are purchasing. It's probably not that helpful. Rely on your broker to show you real exposure data so that you can make a business decision in terms of what makes sense for that next insurance dollar versus spending that dollar somewhere else in the business.
Great. Thank you. Appreciate it. And appreciate all of you guys for spending the hour with me and talking to everyone. I hope they got a lot out of it. So Colin, I'll hand it back to you to just close us out.
Amazing. Well, Janine, Jim, Amanda, and Priya, thank you all so much for joining us to land this IPO Bootcamp plane smoothly and share your insights and expertise. So really appreciate you all and look forward to seeing you all in the new year. For everyone still on the call, we also wanted to thank you for joining us, and we hope this is an informative and helpful guide to the entire IPO process. We love your feedback, and if you're interested in meeting with any of our partners, please take a moment to complete that survey in the chat. And in case you missed any of the sessions or would like to rewatch this video, this content will be available on our YouTube page, so use the link also in the chat to subscribe.